Very good morning to you. Welcome to Trade Live with IG on this Monday, 7/7. Chris Beecham, good morning.
Good morning. Very wet morning.
It is. We needed it, though. Come on.
Yeah. The garden did need it. If I don't sound like a very old man, but yeah, it did need it. But it's completely soaked through this morning.
Really? Already?
Yeah.
We need to get your IG umbrella.
Anyway, the trousers were because it's just deep puddles. It's everywhere. It's really fallen really quickly.
So yeah, good morning from rainy London. There it is. That's it. We started off with a weather forecast from Beachy here. So, well, that looks like a bit of an accident there as well, is it? What's going on there? What's with the lorry?
No, it's just traffic. As soon as it rains, everything just goes to pot, doesn't it?
Yeah, they are terrible. Terrible. What a beautiful picture, though. How are you all? Jay Canham in the chat. Here he is. He wants into the Discord group. He was hassling me all weekend. He's been hassling Angeline. Let me in. He's been banging at the Discord door.
Some people have nothing better to do, do they? No, I'm joking.
I haven't had a chat. But Producer Phil, was there any good Discord chat going on over the weekend? Gonna have to find out, he says. Right, Andrew McKelvey, straight in. SWC, fastest company ever to 1,000 Bitcoin. SWC announced this morning they bought, I think it was 242 Bitcoins. They are at the 1,000 level. No celebrations from the crowd out there?
Quiet as a mouse. SWC
there we go. Right, so what's coming up on this fine July morning, where if you are queuing for Wimbledon, enjoy that queue. Right, Chris Beachy through till 8:30. We got some exciting stuff going on in fast markets today. We've got the excitement in there. You don't even know about
argument. It yet. Oh, right, okay.
It's not an argument, it was a debate.
It's a frank exchange of views, as they say in diplomacy.
We can carry that on if you want. We're not even finished.
No, barely started.
Matt Arbor's back. He has been on holiday. How well tanned is Matt Arbor going to be? That's the question of the day. We've got Dylan Rattigan join us from Milan. It's a bit sunnier there. And then trade of the week.
With a very tired Axel Rudolph, because he didn't get back from his holiday till 3:30 this morning. He landed. He was home by 3:30 when he texted me. So, yeah, I think he might be a bit...
He must be tempted to say no trade of the week this week.
No, he said he will do it. He's too dedicated to the cause.
Or is it short EasyJet on the back of his flight delay?
Angry Axel Rudolph. No, Axel doesn't fly EasyJet.
Oh, no, of course.
Can you imagine?
Lufthansa, is it?
Probably. Business class, I think.
Okay, so that's... that's our... Any stories from the weekend for me before we go?
No, just watching India slowly crush England in the cricket. It was
quite
good. It was a good test. You know, a good 5 days, but they really did win. I mean, they just battered us out of the game. The first team ever to score 1,000 runs in a test match. And
then the England women's team got thrashed as well.
I confess I didn't watch the England women's team cricket.
It was. I must say it was a good game.
Was it?
But they did. Yeah, I had a bet on 1-1.
Right.
And they went 2-0 down.
Who were they playing? India. Are they playing India?
No, it was a good team. France? No. Who were England women's team playing? Who did they get beat by? It was France, wasn't it? Yes, France. So, yeah, not great. But we had a viewer write to us and say thank you so much for enabling the time codes in the program, because it means I can fast forward through the social chit chat.
Oh yes. Well, we like to provide a public service.
I think that's our first poll of the week. Do you want more social chit chat? Do you want less, or have we got it about right? Do let us know. Producer Phil is gonna put that one up. I'm not sure if only time will tell suits that one. So right, let's go into some overnight action then. Get on to the good stuff. So it's a relatively quiet week expected on the front of numbers. It's a quiet week for economics. However, of course, what do we have coming up on Wednesday?
Wednesday. Tariff day. Oh, but is it now? Is it Wednesday now? But look, Nick said it's the 1st of August is when the tariffs come in.
Yeah, but he's sending out letters.
The letters go out today. Disgusted of Washington. Dear sir, I'm very disappointed with your lack of kowtowing to my crazy tariff demands.
Yeah, dear von der Leyen.
Well, did you see yesterday, or was it over the weekend, he couldn't remember the Prime Minister of Japan's name, so he called him Mr. Japan. Which is probably the worst thing since Tim Apple, infamously, from the first time. But Mr. Japan, can you imagine?
I had a bit of go at Tim Apple on my TikTok yesterday.
Oh, right.
And,
I'm sure he's deeply wounded.
Yeah. Well, there's some people out there that were. Woohoo!
Why? What did you say?
I think he messed up autonomous vehicles, right? He put 10 billion into that, cancelled it. VR goggles been a disaster. Apple should be bigger than Revolut in banking. I mean, they've got you there. Apple Pay just doesn't really do anything.
Hasn't really taken off, no.
And yeah, and then he's put his whole supply chain is 100% dependent on China.
Yes, it's a really good new book by Patrick McGee, Times journalist, about how Apple essentially enabled China and trained the equivalent. I think it's a million engineers or something.
Wow.
I think it's a very good book. I've not actually read it, but it's got very good reviews. So Patrick McGee, Apple.
It's incredible, 1 million engineers.
Yeah.
It's like Cuba with their doctors.
Yes, but yeah, there's a fair criticism to say that Apple's policies have meant that China has been given a massive leg up. And if you're the US government, clearly you're benefiting from having one of the world's largest companies within your ecosystem. But when they're helping your enemy, should put it that way.
So my argument is he has to go. Now that he's been caught lying about their AI capabilities, Tim Cook has to go. It's the only way that you get some life into Apple again.
It does feel like it's lost its way, isn't it? It's underperformed everyone else. The Mag 7, the rebound over the last couple of months, has really lagged behind. So you can argue maybe it's just not quite.
When you start getting caught for lying, then
what did he say?
What did he say? Rotten to the core.
About AI. What was that?
Honestly, come in here. I've been thinking about that one all weekend.
Really? There you go.
Yeah, I mean, that's dreadful. S&P 500 all-time highs, and look at the year to date for Apple. Absolutely pathetic.
Very disappointing performance.
Very disappointing.
But it's
20%.
Yeah, with Nvidia marching towards being the first $4 trillion company, and there's Apple lagging behind.
Yeah.
It's a sign that trees don't grow to the sky. We're not saying that it's done, but clearly it's...
Well, what are the remedies? So, number one, so they're well behind in AI, right? They've completely dropped the ball. They've missed it coming, and now they've got to play catch up. So they've got to buy something.
Yeah.
Could it possibly steal OpenAI away from Microsoft and then appoint Sam Altman as CEO?
Could be a move. It's the kind of moment you need a bold move, really, I suppose.
Well, the real bold move is for Tesla to do a reverse takeover.
I think nobody wants to go anywhere near Elon Musk at the moment, given the weekend's developments.
Well, yeah, take us through. What exactly does the America Party look like?
Well, it's as with so much of this, there's very light on detail. Is Musk running himself? Is he just putting up money for other people, which is probably more likely? Obviously, the third party in America does not have a good record. I think Ross Perot is the last one that came close to making any kind of national dent. But it always just ends up taking votes away. And the risk is now, of course, the reason why it's annoying Trump so much with his eye on the midterms is that if you launch this and take votes away from Republicans at a crucial point, with the House especially so poised, that they could lose some of their dominance. And so he could potentially kneecap Trump's second half of his second term. And that's not going to go down well in Washington.
I would hazard a guess that Trump would go to quite extreme levels to make sure it didn't happen.
Yeah, so I think this is the test. It's amazing that we knew they'd fall out. I don't think we thought it would be quite this dramatic and this rapid.
Yeah.
I thought within a year, but I didn't think within weeks of him actually walking out the door of the White House. Or days even, I think.
And you wouldn't have thought that it would end up with Musk starting a rival party.
Yes, well, who would have guessed that two big beasts like this can fall out and then they could possibly be so spectacular? This was always written into the
Two
plot.
big beasts. Wow. Monkey Man saying Tesla should bring out their own phone. Yeah, but the combination of Tesla and Apple would be quite incredible.
So?
Well, the cash generation that you get from Apple funds all Musk's capex, and it means that anything over, a 7-year time span that would take him autonomous driving, robots, imagine where we'd be in 7 years' time. We'd have it in 2 or 3 years.
Yeah. But would they block it? Could you block it under competition concerns, maybe? I don't know what in the US would do.
I don't think so, because there's not really competition there.
No.
It's just
Trump
two mega brands.
Would be very angry, put it that way. So.
Well, it would stop China in their tracks. For all imagine the jumps forward that you get in...
Yeah, if you could align it that way as part of his... I think this still lies at the heart of all the tariff stuff, is trying to detach everybody from China. And it just isn't working. Obviously, everyone's rerouted everything through other countries in Southeast Asia. This is why he's trying to still be so nice to the Russians, despite everything, because he wants to detach them from China.
Yeah.
And then you got the head of NATO over the weekend saying, if and when China does attack Taiwan, the first thing they do is bring up Moscow and say, you need to attack NATO to distract them. This is the head of NATO saying this over the weekend as well. So there's a lot going on.
Book a bit, isn't he?
Kinda, yes. I think he's supposed to,
Yeah, it's a bit. Sounds like Zelensky there.
Maybe.
Now, should we expand on tariffs a little bit?
Are you up with the chat? I forget where we are now with the things.
Well, it's a very confusing picture.
The letters go out today.
5 p.m. London time. We will find out who is being threatened.
Yeah. So it's 10 or 12 letters, isn't it? It's not even very many letters that were suggested. So that's because obviously we've had 3 trade deals. It's the UK, Vietnam, and India.
Was India?
I don't know.
No, UK and India. I'm not sure if US and India had a deal.
UK, Vietnam, and somebody else. UK, China. Okay, China, obviously.
Oh, yeah.
The deal, in inverted commas, which wasn't really, the Chinese have a very different view of it. But so that means you've got EU, Japan, South Korea, India, vast swathes of global economy that you haven't got to deal with. It occurred to me just before going on air, maybe they just won't ever strike a deal and they just won't ever impose tariffs, but they'll just have it hanging over everybody all the time.
He needs the money.
Well, they're already raking in, what is it? The annual rate's 300 billion, so you can...
Well, I mean, these numbers differ. 88 is the one that Trump said. I don't know where you got 300.
Someone's right, an annual 22. Rate, the way it's going to, the way it will be, a monthly rate. So,
well, annualizing the 130% on China, which doesn't exist anymore.
So this is the thing. But if his preference is merely just to leave it hanging over everybody as a sort of threat to enforce good behaviour, tariffs just they never come into effect.
Yeah.
You've got Bessie going, oh, we might impose them, might boomerang back to the April levels, which nobody in their right mind believes. Surely. We saw what happened.
But even Besant threatened that, didn't he?
Yeah, but I think the more Besant talks, the less I like him, the less I'm impressed with him, I think. Because there's what with this and the Fed chairman stuff going on. Again, he was on at Powell over the weekend. Did he call him a very stupid person again?
Which one? Besant wouldn't call
him. No, Trump called Jerome Powell.
Who cares what Trump says?
Yeah.
Right, let's have a look at the futures this morning then, because Friday we actually saw a big retracement. We saw the S&P 500 futures, because remember the market wasn't open. They were all getting drunk on the beach. And so it was interesting. So the S&P 500 is down around 55 basis points.
Yes, let me just get out my magnifying glass to see it.
But the futures are up 26 basis points on the IG platform. So don't let it confuse you. Markets are down around 0.5% from Thursday night close. We're getting a little bit of a retracement in cable. Cable down 30 basis points this morning.
A little bit of dollar strength coming through, isn't there?
Yeah, bit of dollar strength. That's smashing copper. Copper down 1.3%. Not sure if there's some tariff chat there as well. It doesn't look like it because the LME copper is also lower.
Gold a touch weaker as well at 33.11. So, yeah, but of course it's been sell the rallies in the dollar for months now, isn't it? We've not had a proper little bounce in the dollar for about 6 weeks.
Yeah,
so,
yeah. it's been so. Yeah, so let's see what comes out. But oil up 90 basis points. That's despite a larger than expected change by OPEC. Yes, OPEC plus.
Yeah, OPEC plus. It's really interesting that the production hiked to 548,000 barrels, surpassing the initial expectation of 411,000 barrels. Whether it's just to smooth everything down from the last 2 months with the Middle East.
Yeah, calling it a good market.
Yeah, and yet the price seems relatively resilient. So again, the market doesn't like crude oil at the moment, does it? It's not a popular investment. So that alone is enough to make you think
it's found a low.
Yeah, not to just don't blindly be contrarian and go running in, but the fact we had ceasefire in the Middle East and it slumped, but it didn't go any further. I think the price is kind of telling you something there. I could be spectacularly wrong on that, but it's certainly the fact it has seemed to bottom out for the time being. People just don't like energy at all. So there's a sense of it being underweight in portfolios. That's an interesting one, I think, to watch in the near term.
Good. Right. What did everybody get up to at the weekend then? Do tell us. Producer Phil is one of these people that takes the tip off the bill. The discretionary tip.
Does he?
Went out with his pals on Saturday afternoon and they decided to take the optional service off the bill.
Wow. And then what happened?
It was a bottomless brunch.
Oh. So who was it? Was it Rachel Reeves did that last year? She did, didn't she? Yeah.
He's going, my ear is, I'm going to have to turn this down.
Why? What was wrong with the service?
Right, we gave them cash instead. We gave them cash. So it's one of these awful places where the tip goes to the business.
Yeah.
And so he put his hand in his pocket. And
I'd always rather do that, but then so often you just go and you don't have any cash because it's all done by card, and then you're stuck either way, really.
Well, don't forget your Bank of England chance to design your banknotes, Chris.
Oh, yeah. You've been doing a Rachel Reeves one. Sorry, my microphone's just fallen off for some reason. So.
Oh, dear. Oh, that's going to be sounding great, isn't it? You with your hands all over it. Yes, that's right. We've got a link there that goes straight through to the Bank of England. You get the chance to decide what goes on the next banknotes.
Who would you put on it? Who would you put on the next banknote?
King William.
Right. Anyway, apart from the monarch's head, who else would you put on? Go on, say something controversial. Go on.
No, my ideas were Roger Bannister. And when England won the 66 World Cup.
That's really boring.
Oh, go on, then
put Margaret Thatcher on the banknote. That would do. That would wind so many people up. Why not the first female prime minister? Why shouldn't she be on the banknote?
Very true. Yep.
Just alienated half the country there, but I don't care.
No, I like Thatcher. We all love Thatcher. Come on.
Probably this audience do. Yeah.
Yes.
Maybe not else.
Bet you wouldn't say that in the BBC, did you?
No, I didn't. I went on Sky on Friday, and who was on before me? O'Leary of Ryanair. That's always good copy. He had a good old go because it was talking about the French strikes,
right?
And obviously the impact on Ryanair and the fact that he was railing against French air traffic control, saying they always cancel all the international flights and the domestic French flights unaffected, whereas in Spain and Italy and everywhere else it's the other way around. And he was saying, fine, you can have your recreational strikes, as he described it, but don't cancel the international flights because it's not we're not in charge of your pay anyway. Yeah. So he was a very good. I thought I can't be as characterful as Michael O'Leary, but it was fun to listen to him.
Did they ask you some follow-up questions about what he said?
No, I talking about the Big Beautiful Bill.
Right.
So I was the more normal, boring markets person. But yeah, he had a good old.
He is good.
Good copy. Because I asked him, "What, are you off on holiday this summer?" He said, "No, I'm in the office, making sure everybody else gets on holiday."
Now, talking about travel and travel delays, I don't think we can go past the fact that it is 7/7 and it's the 20-year anniversary. What I must describe it one of the scariest days of my life.
Yes. Where were you?
So on the trading floor at Credit Suisse, which in Canary Wharf, and of course markets, the rumours go around the city instantly, and there was a power cut on the underground, and Sky had a camera straight onto one of the tube stations that was affected. I think it was not Russell Square. What was the one closer east, furthest east?
Oh, Aldgate.
Aldgate. And so they had people running out of Aldgate, And so everybody kind of, thought, well, that's a bit strange for a power cut. Maybe there's been an explosion, like a gas thing, and then the market really didn't do much. People had the volume up, but then they interviewed somebody, and it was a man that had come around the corner, and they said, "Sir, you're running. What are you running from?" And he said, "Oh, the bus has just blown up round the corner." And the interviewer said, "Sorry, do you mean a tube train? Like the problem's in the underground?" He goes, no, a bus has just blown up around the corner. And that was it. Boom, like, very scary. And of course, then the rumors went round that there was something going to happen in Canary Wharf, because that would be a target as well.
Yeah.
And the quite a incredible day. And you couldn't get home.
No.
So
walking home, weren't they?
Well, yeah, we took the boat up the Thames to get back, which was quite a nice experience on the Thames. And a couple of the traders from Credit Suisse got a helicopter back to Essex, to Epping Forest. A helicopter.
The reputation of the city, no favours.
Yeah, exactly, yeah. Oh, those were the days. But of course, if you remember, if you were an adult in those times, not like producer Phil, who was in his primary school trip that
grasshopper.
day. Yeah. You remember that the night before, or the day before, was when we won the right to the Olympics, and London beat Paris.
Yes.
So everybody was celebrating the fact that Olympics was going to be in London, and then that happened the next morning.
There you go.
I just finished signing up for my Hotmail. London 2012 at hotmail.com.
Okay.
I was the first one to get that email address, and I've still got it today.
One of your favourite achievements, isn't it? Goodness me. Oh,
right.
If it looks, could kill.
Okay, it is 7:53. It's time for you to get close to the screen there. Come on, get close in. I want to see who gets this first. You remember on Friday I ruined everybody's fun because we actually missed.
That's not like you at all.
Luke and I talked right through this point and got to the open. So we did guess the chart afterwards. So he changed the chart and he said, oh, it's a US company. I guessed it was Intel.
Right.
Like just as a guess. And of course,
it was.
Ruined the game for everybody.
Oh.
So what country are we from today? It's a UK stock. Go on, what's your guesses? See if we can ruin the game again.
I don't know, BAE.
No, I think BAE is too obvious. He's going a bit... He's delving a bit deeper here. I'll go some kind of retailer.
Okay. What are you going for?
Or a mid-cap.
B&M European Value Retail. Something like that. Can you imagine?
Games Workshop. No, he's done Games Workshop.
That's too
last
obvious.
week.
The only 10 bag of the FTSE's had in 20 years or whatever it is.
Oh, no. Let's just go for it. Right. Guesses. Who's going to be first? 3, 2, 1, go. Hamish, you're too good at this game.
He's very good.
Vistry was right. Let's have a look at that. Of course, the big warning. In fact, there was 2 warnings, I think, wasn't there? Back in October and then again in late November.
So there's 3 gaps on that chart, though, aren't there?
Yeah.
So was there a third one?
Oh.
They always come in 3s. That's the old joke rule, isn't it? Profit warnings always come in 3s.
And you buy the third one.
Yeah.
What have we got today? Well, Berkeley has been raised to buy at Peel Hunt with a target price of £16. Glencore is starting the share buyback of $1 billion.
We've got a couple of downgrades. You got those?
And no, go ahead.
BAE cut to reduce at Kepler, and RBC have cut Currys to sector perform. So a slightly spicy update there from
Yeah,
RBC.
they've done well on Currys, to be fair. And then Weir Group raised to buy from neutral at Citigroup. Price target raised to £29 from 21.
Upgrades flowing through for Weir Group there. Thank you.
Where? Oh, very nice. Currently £25. Okay, so 15% upside there. And then we've got, well, Shell. Shell Q2 update sees Q1 adjusted earnings higher. Yeah, not. Let's see if I've got something bit more on Shell. Do you have a?
I'm just trying to see what it's. Did briefly look at the numbers this morning, but
down 1% is the call on Shell. Q2 upstream production 1.66 to 1.76, and integrated gas outlook 900,000 barrels.
refining margin slightly better. Trading optimization performance is supposed to be weaker than the previous quarter. So a very mixed bag from Shell there this morning.
Oh, Deutsche. Are we ready? Let's get a drum roll there. Come on, team. Let's get a drum roll for this one. It's 7:59 and 27 seconds, because this might actually be why they were so strong on Friday. Vodafone, Deutsche, Numis increased their target price to £1.35, people. £1.35 target for Vodafone. Shares are doing better after a slow start when they were trading more like a FTSE stock than a telco. So yeah, there you go. Get ringing. That might have been out Friday. I'll find out. That
Probably,
might be why they were so strong.
They were very strong.
Ring that bell, Chris Beecham.
We've not seen 135 on Vodafone since the beginning of 2022.
Beginning of time.
Yes, in the dim and distant past. It might as well be for all the performance you've had in the share price.
I actually remember trading them back in 2019 when they cut their dividend and they were at 135. And that's what they dropped to, I think. Maybe 150 down to 135. Right, we've got Shell share price. Straight away, we see it down. So yeah, Shell down 1%. That's right. BAE Systems down 80 basis points on the back of that downgrade. Is that annoying you? Is that getting under your skin? BAE Systems very well held, and a mere downgrade can take it down 80 basis points.
Yeah. Well, they've had a good run though. They look vulnerable in the short term, don't they? I suppose.
What do you think?
Defense generally. Yeah. I mean.
What would you do that? Just hold it forever like you like
Yeah,
to do.
that's what you do. Never ever sell. That's not advice, by the way.
Glencore down 50 basis points around that £3 level, and British Petroleum down 70 basis
All right,
points.
Obama.
There's. Where you go? Yeah, there's Shell down 1.8 now, down 1.8% on Shell. So yeah, taking a bit of a hit there on the back of numbers.
Is that the trade line up 4%? Did I see?
It does tend to have quite volatile opens, but it is a wide spread there. But yeah, still strong.
Drive a train through that spread, etc., etc. But yes,
That's quite good for you.
no, for me. Oh gosh, why is it up 4%?
The Standard Chartered, excuse me, up 1.3. HSBC up 50 basis points. Anything jumping out to you there, Chris?
No, very slim order. There's HSBC. It's sold its life insurance arm, I think Times was saying. So there's
Okay.
another disposal there from HSBC.
Rolls Royce 966. Do we see £10 in Rolls Royce?
Today?
No, not today.
Not today. Wants to go there.
It's so close now that you'd feel like it.
Yeah, always beware the round number once it gets there.
Yeah.
There's a lot of people just itching to hit the sell button. Not me, obviously, but you know.
Vodafone up 20 basis points, nearly 82 pence. That's right. It was up 3% on Friday. Can't keep a good stock down. You've got
Sorry.
Bars Iron Brew at 6.98. WH Smith now down. They've really struggled, WH Smith, haven't they?
I think that, well, now they've shorn themselves to that miserable high street arm, I suppose it'll just take a little while to pull themselves out of that. But
yeah.
Because they're now an airline, it is an air travel stock now, isn't it, really? It's a travel stock, so it'll stand and fall by how airlines do and how holidays.
At least airports. Maybe like, what's the French airports?
Oh.
Starts with A.
Aéroport de France. I don't know.
AF. Yeah. What is it?
Answers on a postcard.
Yeah.
Not a postcard, it's too slow.
French airports. It's a good company. I remember, I think Macquarie were interested.
Aéroports de Paris. ADP. Not that ADP.
How's
last
that?
week.
I got to look how that traded because I remember. Oh wow! Oh, it's come off. I remember this stock. 2018, 2019 was a potential bid target, and it's never come
Look at that.
to fruition.
Miserable share price.
There it is. I guess. Oh yeah, of course. COVID. It probably put paid to that, didn't it?
Yeah, there you go.
So it's never recovered. It got up to €200, and it has literally never recovered from COVID. Interesting. Right, let's have a look what else is happening in Europa this morning. We have Stellantis down 2%.
Ubisoft, Philips down 1%. Total off a bit. Yeah. Cars, Stellantis, Porsche, Renault, all off this morning.
Yeah.
And Mercedes.
Well, they'll be worried about the letter they're going to get at 5 p.m., won't they?
The letter.
Bit of a bounce. SocGen up 1 there. Airbus flying high up 70 basis points, as are Air France. And Rheinmetall, old Rheinmetall against BAE.
It's the example of the great thing about the market. The strength just tends to beget strength, and it just tends to push on. Why is it up? Well, because people still want to be in that. It's a compelling story, isn't it, Rheinmetall? Germany spending on defence.
Well, yeah, but BAE.
There's diversions, but it's
be a nice pair trade this morning then.
Maybe, yeah, short term.
Adidas 206 struggling. It got up to 210, but it's starting to struggle there, and as Nike hits $76, then Adidas on 206. Siemens, Eon, BNP, just a bit of a general markup for some of those. But let's have a look at commodity world. What are we seeing there? Well, oil, just fit that in, can we?
So was oil expecting OPEC to go even bigger? Is that what we should read from this?
That's a bizarre move. I don't understand that one.
Okay. I'm going to go for the short covering. Doesn't really work for oil prices.
We saw OPEC increase production by more than expected, but also Goldman's coming out and expect a further increase in September of 518,000 barrels. That means that, do you remember the 2 million barrel production cut from last year? Well, that means they've put all that back on the table.
Back on, yeah.
A year earlier than expected. So there's a few questions around that. Why are they doing it? Well, first of all, obviously to regain market share, right? OPEC want to be involved because if it's drill, baby, drill, then they need to be part of it. Are they playing into Trump's hand? Has Trump requested production increases and Saudi want to be on the right
Well,
side?
yes, I mean that's the logical explanation. But of course, if that does drive oil prices down, all those US shale producers are going to be hammering on the White House door and saying, "Look, what's happened to our margins."
Well, that's the bizarre thing. The shale producers need $60 to $65
Exactly.
oil.
Yeah,
So if Trump wants $50 oil, then he destroys his own.
wants to wipe out a vast swathe of US industry,
So maybe that's what Saudi are thinking.
so they can please him and kneecap. Second time I've used the word kneecap, so I apologise.
Well, they increase their market share.
Yeah, exactly.
shares
Crush the
down.
competition.
Yeah. Or is it to punish the likes of Kazakhstan, Iraq, Russia even, and just let them know who's boss?
Yep.
So, gold. Oh, platinum. Oh my goodness, I have not seen platinum up that high.
Falling out of bed.
The last time I looked at platinum, it was 1280. Did it really get up near to 14?
Evidently, is that because it's sort of
400?
replacement for gold? People buying a bit more of that. Yeah, absolutely massive run in May and June.
Right. Have you taken advantage of that that platinum move? It got up as high as 1,430, I should say. Absolutely monster run. That was the one to be in. Just as Anglo Platinum listed or delisted from Anglo American and floated itself in the London Stock Exchange.
I mean, palladium had a fantastic run from the April lows. You kind of think it's a gold's. People are just worried that gold's looked a bit tired at these levels. We'll just swap out into palladium maybe as another sort of precious, semi-precious metal.
Mm-hmm.
Yeah, maybe that argument's there. Silver off, of course, 1.2% as well this morning.
Right. So yeah. So let's go back to that commodity page then. So we're seeing silver. You say that's
Yeah, silver off 1%. Nearly trading 36.50.
And yeah, copper. Yeah,
So that smells like a strong dollar trade for the precious metals this morning, doesn't it?
it does, doesn't it? Which makes oil all the more.
Yeah, the mystery of oil deepens. Very murky oil.
Let us know if you have seen any reason why you think oil is up this morning.
Then I can steal the idea and write it down later. So
Yes.
if you would, that would be great. Thank you.
Right, what were the poll results? Go on in that poll, 34-minute poll. That's the longest one we've had, I think. Do we like the level of chit-chat on the show? This is from a viewer saying that he loves to fast forward through the
You can't please all the people all the time.
social chat. 17% agree with him. Yeah, I agree with him sometimes. I fast forward through Angeline.
I'm sure she does the same to you, really.
Oh, I thought
You fast forward when she
I thought
talks
was
about
in there.
Davos, and she fast forwards when you talk about Vodafone. That's probably the way it works.
Yeah, exactly, yeah. One for one.
Yeah.
Good morning, Jesse. Good morning, Gavin. And good morning, Kate Murphy. Welcome back to the UK. A big shout out to your grandfather there. She was sitting watching the Formula One with her grandfather yesterday, getting very excited.
Oh, it was Silverstone yesterday.
It was Silverstone yesterday in the rain.
Yes. All the helicopters flying over our house, so obviously going from back and forth.
Are you up that way, are you?
Well, we're clearly on the flight path from that kind of area
Right.
to Silverstone.
Very good. Okay, so curries. Yes, sorry. Curries are getting smoked.
6%.
Down 6%. Let's have a look at the whole UK retail sector and see.
They've had a very good run. They've had a very good
But deservedly so.
Yes. Yeah, I think they've clearly nailed a lot of their problems down, it seems. So to go from 70p a year ago to 116, very, very good run. Very well done,
I
anybody.
feel 6% is a bit harsh for a downgrade from buy to hold.
Yeah.
Because it's met their price target.
Yeah. And still only 12 times backward-looking earnings. That's interesting.
Still only on 12 times.
Yeah.
Because earnings have gone up. This is a great lesson for anybody in PE ratios, that Curry's earnings have grown so much that despite their move of 50% in the stock, they're still only on 12 times earnings. So that is the kind of share price increase I like to buy into.
Yeah. Market still has to re-rate it, doesn't it, really?
Not like Nvidia, which just expands the multiple all the time.
Well, share price still go up, though. Number
And
go up.
Palantir. Does Palantir even have a PE ratio? It's too hard to work out.
The EUs do love this old-fashioned investing mindset. It's all about the hype. You know, PE ratios are very old-fashioned.
The hype. Let's have a look at what the hype is doing this morning. What is SWC? It's down. What? How can it be down after they've bought 1,000 Bitcoin? That's right. So 315 to 330 is quite a wide spread, but you can see that magnanimous 7-day rally there from £2 up to £3.20. A nice solid 60%
In a few days.
in a week.
In a week.
So yeah, tell us your thoughts there. His next target is 2,100 Bitcoin. Is he going to get there? Of course, 2,100. Let's see if anybody can get why he's chosen 2,100. Let's hear in the comments. Why has Andrew Webley decided the next target will be 2,100 Bitcoin by the end of this year? Let us know if you can work that one out. We'll leave you that for the break, and we shall see you for Fast Market shortly.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, the fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
In the last video, we talked about earnings per share, or EPS, using pizza slices to explain how much of a company's earnings you, as a shareholder, would get for each slice or share that you own. But today, we're taking it one step further, and we're using EPS to calculate the PE ratio. And this will help you understand what a share price actually represents. The PE ratio stands for price to earnings ratio, and it's one of the most widely used tools to measure a company's valuation. But what do I mean by that? Valuation is essentially the price you pay for something compared to what you get in return. Is it worth it? Whether you're buying a car or a house or shares in a company, valuation helps you decide if the price you are paying is fair. Now, in the stock market, what you're getting is a share of the company's profits. The PE ratio tells us how much investors are willing to pay today for those earnings. But why is this so important? Because it helps us compare companies and decide whether an investment looks cheap or expensive relative to others. Now, let's take a British construction company, for example. Imagine this one block is the company's EPS, and that is £1 per share. When you're buying a share, you're buying into the future profits of that company. But to avoid overpaying, you need to know how expensive the price is. Now, too many people jump in to buy a stock just because they love the company, without paying attention to the price they're actually paying. And it might sound crazy, but a share price alone doesn't tell you how expensive a stock is. The valuation does. Now, this is the important part to get. If the EPS is £1, then how many blocks of earnings am I willing to pay for a share? What's the right price? Is it 12 times or £13? Or if our construction company's PE ratio is 14, that means investors are paying 14 times the current earnings to buy a share in the company. So the share price is simply 14 times or 14 blocks built on top of each other. Now, why have I chosen 14 times? Well, that is actually the price of the FTSE 100. Adding all the profits together of the top 100 British companies and then dividing them by the number of shares, we can say the FTSE 100 is trading on a PE ratio of around 14 times 2024 earnings. Now that looks fairly cheap relative to its own historic PE of 16 times. Now, the PE ratio can be seen as a snapshot of investor confidence. A lower PE ratio might suggest that investors think the company and their profits aren't growing very fast, while a higher PE ratio often means investors are expecting big things in the future. Now, let's compare our British construction company, or the FTSE 100, to the S&P 500. Which tracks the 500 largest companies in the US. Now, its PE ratio is currently 24 times earnings. And that means investors are paying 24 times this year's earnings per share in the S&P 500. And you can see the difference right here in that valuation. That's very expensive relative to its own historic value of only 18 times earnings. But here's the big question. Why is the S&P 500 trading so much more expensive than the FTSE 100? Is it overpriced? Or are there other factors at play? Well, that's what we'll explore in the next video when we look at something crucial, the earnings growth. Welcome back to Fast Markets. So we have got a lot to cover here. The first, I've mentioned the upgrade at Deutsche Bank. Vodafone going to a 135 price target. Let's take you through their analysis, because I know Christopher Beecham's very excited by this.
Bated breath.
They have moved up their expectations for EBITDA by 2.6% in 26 and 5.5% in 2027. Due to the UK deal with Hutchison, adjusted free cash flow moves 5% and 8% higher. Free cash flow moves 5% and 8% lower because of the UK deal. There is accretion there in full year 2029 as synergies come through. Vodafone, ex-Vodacom, the African unit, and ex the JVs, trades at 3 times EV to EBITDA and a 70% free cash flow yield. 70% free cash flow yield, Chris Beecher.
Impressive.
That is far too cheap for a European stub, in our view, though the market want to see evidence of business stabilization. That will come more from Q2 than in Q1 trading on the 24th of June. So, a little bit of surprise there that it is, I wouldn't expect it to necessarily go into the high 80s on this 24th of June update. But ongoing buybacks, that's 9% of the market cap, which was always my argument, and a healthy dividend of 5%, which we now assume will grow from full year 27, and the prospect of JV monetization and the underlying valuation warrants upside in the interim.
Ta-da!
Wonderful. So we go from something like that is cheap, in Deutscher's words, far too cheap, to something that is absolutely insanely expensive, such as Palantir. How does that describe what the market's like at the moment, Chris? You've got a whole load of value stocks that have had the biggest underperformance ever in 2025 versus all the growth names and the retail favorites.
The market still seems to love more than anything else is this dash for some people would say it's a flight to quality, to expectations of future growth, that you're going to go where these companies are expected to deliver. The risk, of course, is that they trade on such frequently such eye-watering valuations that if they disappoint, if they don't meet those targets, you can get, like what we had last August with Nvidia, it can fall out of bed very, very quickly, can't it?
What does it mean to be? Let's have a look at the chart of Palantir there. So you'll see April we had it at $68. It's now double that, exactly double that, in fact.
Full year December 26 PE forecast 231 times earnings.
And sales? 102 times sales.
81 for the full year, yeah.
What does that actually mean?
So the price is trading at 81 times the expected level of sales they'll generate per share over the next year. So you're expecting them to do incredibly well at those levels, aren't you? The risk is, that bounce from the April lows to where we are now is fantastic if you've been long it, but it is baking in an awful lot of good news that they've got to meet when earnings roll around. And when's Palantir report earnings? Fairly soon, I imagine.
So remember, you're buying stocks
August the 11th.
or you're holding stocks because you think they will go up. You want capital appreciation from a stock like this because you ain't getting a dividend like in Vodafone.
No.
So if you're seeing a stock like Palantir at 10 days ago, 144, what do you think the upside's going to be? Why do you continue to hold that stock when there's potential upside in other areas? I do not understand somebody holding that stock at 144.
Yeah, well,
What do you actually expect?
The risk of repeating our conversation of last week in a way.
Oh, that's what I was gunning for.
I think, again, if it was me, I'd say, okay, if I wasn't already in Palantir at those levels, I said I wouldn't be buying it now. But if I was already in, I'd be prepared to say, okay, it looks a bit rich. I'm not expecting it to keep doing what it's done the last 3 months, but I'm expecting it, or you can say hope maybe. The expectation is it will continue.
Completely hope on those valuations because you're predicting that their earnings upgrades will be far superior to what the whole market thinks.
Yeah, certainly. But if you're thinking about buying it at those levels, yes, I think you are. And if you're already in, you're prepared to say, I will weather this for the time being, take that risk, and if it comes back down a bit, if it comes off, we find ourselves at 110 in September.
Yeah.
Let's take the froth out, and then, because you see this over and over again with these names in this market over the last 5 years, they get frothy, it gets very silly, and it does come off. And then it goes off again, and it's... So
let's have a look at exactly what Chris is talking about. Let's have a look at Nvidia. Nvidia last year trading at $144 a share. In fact, it traded there traded at $136 a share as far back as June, so 12 months ago. So you could have taken the money out and you could have put it into a bank account paying 5% interest, and you would have the same return now being in a risk-free savings account than you would from being in risky NVIDIA.
Without the volatility, in the short term. But as we saw, it gave
12
you
months, isn't it?
Yeah, the market then delivered you a chance to get 92 within a very short space of time.
Which you then take your cash back out of the bank and you buy 140% of the number of shares that you had previously. Now, Palantir, I do not understand why you wouldn't do some kind of options trade here. And I'll show you what I mean. So let's say you've sold, right, it'll get up to 140 again, because we all know that it does. So if you go to the end of this year and you say, do you know what, the end of this year, I'm pretty sure that Palantir at some point will drop from 145 to 110, but I like the stock, so I'm going to stay in it. And I don't care it goes down to 110. Rubbish. Be more active with your management. You can go onto the options trade here and you can look at December. You can take the cash that you sell Palantir at, you put it into the options account here, and you sell a put at 120. And for that, you receive 13% of the stock move, right? Or where it is trading today at 140, you receive 10%. So just from promising that you'll buy the share at $120 in December, you get 10% upside more, and you miss out on the drop from 140 to 120. That is an option that is really seriously worth thinking about, because Palantir has to go up 10% just for you to essentially break even in that instance. And at 102 times sales, that means it's got to go up to 112 times sales.
Yeah, and I think Palantir is one you don't always have to be in a stock. You don't always have to be buying it just because you like Palantir. Fine, for whatever reason, but you wouldn't be buying it up here. That's what I would say if it was me. So I don't want to buy it up here.
Yeah.
But if it came off, say, if you had a nasty earnings on the 11th of August is earnings day for Palantir. So put that in your calendars, everybody.
Which date, sorry?
11th of August at the moment.
11th of August.
That might still be expected rather than confirmed. But if it has a nasty earnings report, it's enough just to knock the stock into September, then you have to be ready for when it has that drop and then starts to bottom, because a lot of people then wait, I don't want to buy it now, I'll wait for it to come off 15%. It promptly does come off 15%. And as I had a conversation with some of our premium client managers last year with NVIDIA when it was dropping, I said, well, what if it drops 20%, you get a chance to buy it? And of course, they didn't, or no, people didn't. And then you look at it in 6 months' time and it's rallied again. And there was your opportunity, but it's always that moment of, I'll wait for it to come off. It does. And you go, oh no, but it might go further. Well, yeah, it might.
But it doesn't matter because you've sold it.
Exactly. But
Monkey Man asking, isn't this the same conversation as Rolls Royce? No, sorry. I think some of you might have actually misunderstood what I was saying on Rolls Royce. I do not have a view on Rolls Royce at £9.60 on whether to sell it or not. I am giving my personal view on Palantir that this is absurd price at $140. Rolls Royce, my conversation was that it came from Kate's question. She didn't want to buy any more Rolls Royce, not because of a view on the stock, but because it would take her average price up, right? Which is what people genuinely, a lot of people, I'm, not saying that this is Kate's fault at all. It's a lot of people's view is that by buying at £9.60 and adding to the trade, it ruins your in price. SWC, right? I'm kind of thinking about buying it today at £3.20, but my in price is £2.20 or something. So suddenly I'm going to take my buy price up more. I think that's a psychological thing and should not come into your thinking. Therefore, what I was saying in Rolls-Royce is that you get rid of that by simply selling it, taking the profit, and then buying it back at £9.60. So you've got zero profit, and your in price is £9.60. So there's no difference. That was the Rolls-Royce. Whereas I'm saying in Palantir, the options market is giving you such a high vol that it's worth considering replacing that stock with an options trade.
Yeah.
Now, speaking about options, Matt Arbor's back. Do we know where he was on holiday?
Somewhere expensive.
It wasn't Magaluf, was it? Where's producer Phil? Where was Matt Arbor on holiday? In Devon. Very nice.
Oh.
Staycation.
Doing his bit for the UK economy.
Do we think he was surfing? The windswept hair?
No, I shouldn't think so.
Right. Thank you, everybody. So that is me for the day. Angeline coming up with Matt Arbor next. Chris, thank you very much for joining us this morning. Excitement for the rest of the day?
I'm going to work out why oil is still up. That's my key answer to the question.
And awaiting Axel's holiday stories.
Yes. And then so I see what's in the letters, the tariff letters later. That's going to be fun, isn't it?
That's right. So watch out for those tariff letters. 5 p.m. London time today. And yeah, best of luck for that. Is the S&P going to rally to be up on the day?
Well, it goes up every day, really, these S&P, doesn't it, really?
Goes up every day. Of course it does.
Risk-free asset.
Right. We'll see you after the break.
Bye-bye.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Hey, trader friends, welcome back with myself and Matt Arbor, live from the trade desk.
Morning, Ange. How are you?
Very good indeed. You look so calm and relaxed. You look sun-kissed.
I was only off for 3 days.
Oh my goodness.
Not proper holiday yet.
Where is Matt? Where is Matt? He went off to sunny Devon.
In sunny Devon.
And look at his nose.
Good Lord.
Oh my goodness me. Was this during the heat wave on Wednesday? And
It was during said heat wave, although it was overcast in Devon, which is why I caught the sun, because I was, naively assuming That the UV couldn't get through the clouds.
But you're not like, I always pictured you as one of those people with, fluorescent T-line, and with the...
Normally I'm a strict adherent to the factor 50. It's good stuff, but
Right.
yeah.
So, we need the factor 50 and more, because apparently the heat, trader friends, you're hearing this here first, is coming back from Wednesday onwards.
the heat.
Yes, the heat, both from the sky, not so much from Trump, because he's kicked the tariff heat down the road as we expected. We talked about this quite a bit here.
Always kicking
For
it
your
down.
holiday. And now the deadline has moved. So for those of you watching this space, I'm going to try and bring you up to date. I know you've talked about this already this morning, trader friends, but I have come in early to crunch some numbers for you. And here we are. Let's whack that up. So the US tariff announcement, this is where we're at the moment. We were expecting this week, July 9th, the deadline for final negotiations, but that's been kicked to August 1st.
Well, yes. More time for deals to be done, obviously.
Yeah, more time for deals. But he says, Matt, he's written letters already that, he's sent them all out, 10 to 14, according to the 10 to 12.
Did he fax them?
Did he fax them? Yeah. Did he send them through Royal Mail?
Yeah.
Take a while.
It's the art of the deal is still, wonderfully still done through letters,
Yeah.
perhaps.
Yes.
No, it's interesting that the markets are seemingly in this sort of sleepwalking towards. I'm not sure. Volatility remains resolutely low with few concerns. Even kind of the new Musk Trump spat doesn't appear to have affected headline volatility, albeit the effect on or expected effect on Tesla when we see it open in all sessions down about 5%.
Yeah, and also I did make some effort to kind of look at what might happen with the new Trump party. We'll get to that in a moment. If you come off my screen, I'm going to try and get the volatility chart up for you. And here we have it. Let's take a look at S&P 500, checking in on the daily first. Look at that, squashed down, crushed.
Look at that, exactly.
Oh my goodness me, 15 there.
15, it's kind of surprising now. Again, often this is the instance where markets are trading towards their highs. Vol naturally comes off lower into these steady up moves. But, these numbers really believable given nothing has actually changed? It's a strange one. It's very much summer complacency in markets has set in, and a sort of everyone knows who's been doing this for a while that August, often trailed as the quiet month, is when funny things often happen.
And do you think this has just moved forward then? Do you think July is the new August?
Well, it's that we're waiting for signals or waiting for something with no fresh impetus. It is the default stance is to just buy stock, but it's quite strange that the market is pricing such a risk off response given what we saw in the preceding 3 months.
Yeah, I mean, it's an incredible time for volatility to be this low when we have these tariff deadlines, when we also have Musk forming the America Party.
Yeah.
Was that during your holiday, or were you kind of back?
No,
already?
I was back. I was back at the end of last week, so that was over the weekend, wasn't it? That was.
Yeah. So, I mean, this is the interesting thing, because, I had equal number of people that were excited and for this, and equal number of people who messaged to say this is terrible news, especially if you're a Tesla stockholder. And just keeping all of you abreast, if you're just joining in now, Musk is forming the America Party, opposing Trump's tax bill. A lot of this moving Tesla's share price. Let's put that up for you, because this is the first thing that Matt and I talked about this morning.
But it's...
Yeah. I mean, it's just this. Let's just give you the hourly. That might be give you. There we are. How do I get that back, guys? For some reason, here we are. I know. For some reason, this is has started glitching since Thursday and Friday. Right, here we are. We're back to the hourly chart here, and you can see there.
So that's still got Friday's closing. Obviously, on the weekend pricing, people were trading this on the sort of IG market over the weekend down to sort of the high 29s. It's suggested in Asian trade where Tesla is trading as proxies on some exchanges that we are opening sort of around the low 29s, so down 5% on the news. So it'd be an interesting one to watch when full access comes in on all sessions.
Yeah, which is in under 15 minutes time. Which side of the camp do you sit on, Matt? Do you think this is actually really going to be bad for Musk's credibility, and the fact that he's, we've seen what happened when he joined, Trump, and it's going to be amazing. This romance, he said it won't last for long, right?
Well, the narrative throughout has been a strange one. First of all, it was the best thing for Tesla's share price that Musk being close to the president, and then when they had the little breakup initially, it was also really good for Tesla's share price. It's similar to crypto. There's no bad news around Elon Musk a lot of the time.
Yeah.
The people who believe the story, believe everything that's there. It's still all about robo-taxis. It doesn't matter if you're selling no cars anymore. It doesn't matter if people actively are against your brand, because in 20 years' time it'll be robo Teslas driving around, won't it? If you believe the story,
the narrative,
yeah.
Yes, the theory. But how about in the more, closer term foreseeable future? Because there is a lot of concern now that with his eye on, politics, this might mean that, he is then less of a cult leader for all those Tesla retail investors, and they might just fall away. The other thing too is that this, feud with Trump could impact the 2026 Republican election chances as well. It looks...
Well, the GOP isn't... it's not new having schisms, Remember the Tea Party of, I can't think how many years ago, I'd like to say 10 years ago. Perhaps it was shorter, perhaps it was longer. It's difficult to recall. I suppose Musk is emboldened by what's happened in the UK. But it's coming from a different perspective. The rise of reform from being in opposition, or the right being in opposition, is a bit different to being in power. It is an interesting development. Does Musk really have the energy to pursue this, or is it another one of these that burns out quite quickly as he tires of perhaps prodding the bear, or moves on to the next thing?
Some people at the weekend that I follow in the markets, some saying that potentially if this becomes a long drawn out battle between the two, then perhaps, you could see that those sectors likely to benefit are, Tesla's EV competitors. Also, sectors likely to lose out include automotive, heavily regulated sectors that are reliant on government contracts outside of Musk's direct interests. They could face uncertainty. So, a lot to play for there. We have plenty of people on the chat as well. Good morning, Kate Murphy, all the way from New Zealand. Kate saying Vodafone doing well. She's in the UK now. I've been told by Phil you're in the UK now. Wow. When did that happen? And also, we're also saying good morning to Monkey Man. Monkey Man also joining us after his morning exercise. Gavin, PEP, if my number's correct, usually trades at 25 times earnings, currently trading at 18 times earnings. Right, let's have a look at the economic calendar.
Let's have a look this
for the week.
What is going to bring some excitement this week? That's what everyone wants to know. And
Let's have a look. So we've got
another particularly uninspiring week, to be fair.
It is quite quiet-ish today. Take us through the economic calendar, Matt.
Well, European retail sales, never much of a market move. I suppose that the eye would be drawn here onto the FOMC minutes, but the Feds, we know what Jay Powell thinks. He's been quite resolute, and that ain't changing, is it?
Anytime soon. Data dependent still, until we see some of that inflation data
Well, that's it. And as he kind of has worked out after his missteps during COVID that inflation tends to lag. You know, the idea that the effect of tariffs isn't there. Everyone has shipped their containers already. So we saw that kind of spike in activity beforehand, before the expectation of deadlines.
In the first quarter.
Exactly. And then as and when tariffs come in and the inflationary effects there feed into the market, it's a longer term effect. And of course, you know, remembering the mistakes made in COVID, believing that inflation was benign because, you know, prices didn't start moving until they moved.
Bottle of wine was not benign.
Well, it was benign until it wasn't it? And that was it. The Fed were very slow to react, probably not as slow as the Bank of England, but to know that the pressures were building, the inflationary pressures were building, that prices were obviously going to go up.
Yeah.
But because those frontline numbers weren't reflecting that, they weren't proactive.
Do you think it's going to be delayed and it'll finally come through, or do you think actually we're not going to see much of that inflation impact till sort of latter part of the year when things start getting really bad near Christmas?
Well, it's in the US. It's hard to know. US consumer tends to have been a bit more resilient. I certainly think in the UK, this idea. You know, the unrelenting stream of bad news, the concept that there's natural pricing pressures from consumers. I think people are sitting on their money. No one thinks there's a rosy outlook, or that there's any prospect of things getting better quickly. So it's, you know, the UK is a very different story.
Out of the ones that we had on the chart, for me, I think the China number is going to be the more interesting one. I mean, inflation we know is very subdued so far this year. We know that the Chinese government has been trying to support the economy there. Many who work in the commodities sector, especially copper, especially gold, especially those mining alumina to make aluminium, so all related to China, have said that things are not really bad there, but, you know, it's just not great. You know, stabilizing properties still, market there still, you know, cracks everywhere. But, you know, if we see consumer prices continue to show weakness, and we see, you know, more signs of deflation, then I think we are potentially going to see a reaction on the markets there, because there is this real concern that whilst the US is sorting themselves out, China is in trouble unless they pull out this bazooka and start, you know, really supporting the market there. Yeah,
well, and I suppose the sort of adjunct to that is keeping an eye on Japanese numbers, because the signs of inflation in Japan, as we all know, are huge holders of US treasuries, and the trade, as soon as inflation returns back to Japan, the onshoring back into JGBs rather than treasuries, to get the yield and the consequent knock-on effects on the yen. So I like to talk about dollar yen a lot, even though it's often very boring. But this is generally where you see the first shoots.
It's the canary in the coal mine.
It's the canary in the coal mine, yeah.
Exactly. And speaking of Asia, we've had some questions earlier on from the chat. Right. Thank you, producer Phil. He's going to show us where it is. Monkey Man asking for your views on MetaPlanet.
MetaPlanet is another, of course, of these MicroStrategy clones. It's called MicroStrategy anymore, strategy clones.
Yeah.
Bitcoin funds that has had a spectacular. I don't know if you can get the chart up. I'm trying to think. Last I looked, which was about a week ago, it was about 1,500 yen, or is that 15,000 yen? Hard to know in yen. But some really good volatility there for those who are there up trading in Asian hours.
We don't seem to have it on the platform.
I think I think it's 99.55. It might be 88.55. Search by its number. Is it 99.55?
It's not 99.55.
88.55.
You know the number. No, it's not 88.55 either. 88.55 is China Water Affairs Group.
Okay. Well, META Planet.
META. Is it one word?
Yeah.
It's not coming up on mine. Oh, it's not on Spreadbet. Right. Okay. It's not on ISA either. We learn a new thing every day.
Japanese shares, only on Super.
Japanese shares. I love, my favorite Japanese share is it Toyota?
You stick with one everyone knows.
And what was the other one? There's 8888. There's a Baidu.
That's of course not Japanese.
Yeah. You wish we had someone.
That's in Hong Kong.
In Hong Kong, yeah. So you can wish we had someone else ask about. Is it KMK? Right, KMK. Who was it?
KMK.
Can you show me who asked about KMK Group?
Kate Murphy.
Kate Murphy. Wow, what an amazing. This is one I never thought I would see on this chat. Because KMK Group, which is probably also not on Spreadbet but CFDs, is that company that makes all sorts of things that are linked to trainers. And I think they make trainers out of Indonesia and places like that. So,
okay, so a tariff stock?
Yeah, a tariff stock. Not one that I've traded, but as Matt rightly pointed out, tariffs matter a great deal. We already seen that that deal or that MOU with Vietnam. So if you are in the stock, please make sure you've got kid gloves on, especially during that August 1st. That's the new deadline, isn't it? And another one that we have had this morning, I think it is from, is it Andrew McKilvey? ITM, is that right? Is it Andrew McKilvey? Cool, thanks Terence. Right, so this is ITM Power. Is this one that you've come across?
This is not one I know, but look at that. That's had a fantastic run up.
It's a lovely share price here. This is a daily stock trader, friends. Not one that I've traded either, but just looking at this from a technical viewpoint, showing a lot of optimism there. Very bullish since 30th of April. Lots of big green candles there. And seemingly marching higher. Let's go to the left. We always say go to the left of the chart here. But look
tells a different story. What's ITM's going? On the fundamentals, it will give us a summary of
ITM.
What are we doing?
It is in a growth phase with improving sales, still unprofitable though.
What power are they offering us?
They are. It's not one I've traded before.
No, that's why I don't know it. It's an interesting. I hate their names that I don't know.
No, right? I was very impressed that you knew Diploma the other day. Renewable energy company headquartered in Sheffield and designs and makes electrolyzers based on the proton exchange membrane technology to produce green hydrogen.
Green hydrogen. There we go. Yeah. Well, everyone loves the idea of green hydrogen. Is it the future? Is it too volatile to store properly? That's the question. Can you trust putting hydrogen through your pipes into your home?
Yeah, or or will you have a big kaboom if you crash?
Well, this is the worry. There we go. Thank you. There we go. The chat. We should have just looked on the chat, telling us what we need to know. Of course.
Amazing. We'll get Axel to take.
I always think if you're based in Sheffield, this probably shouldn't be your business doing green hydrogen because you want the cheap source of electricity to do the electrolysis.
Yeah. Right. Do hit the like and subscribe button because we can then bring you more of this valuable information. And also, or you can bring us more of this valuable information. For those of you, Monkey Man, thanks for pointing out XPeng, because XPeng, of course, is the car maker that is listed in Hong Kong. It's listed elsewhere too, but I'm looking at the Hong Kong shares, and it has moved lower recently. But XPeng is trying to really dig deep and expand in Europe. And for those of you wanting to see how I drove an XPeng with my thumb, I will be posting an XPeng video of myself.
Another weekend in car dealerships.
They drive it to your house.
Drive it to your house.
And they leave it with you.
Okay.
They're very trustworthy. But the technology is incredible. Right, we need to get to break before we come back to all sessions. So stay where you are. Message me if you particular stocks you are following in all sessions.
Oh, there we go. Thank you, Andrew.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
Hey, trader friends, welcome back. And we have Rich and myself here for the alt sessions for you.
We're just laughing here. So I went out to get Anja a coffee, as is my job. Once I come off here, I've got to do my proper job. And while I was out there, I noticed SWC dropped below £3. So I've gone in and bought some. But producer Phil, I've come back and producer Phil said, I've just bought some. I said, great, what price did you get? $2.93. I had to pay $2.97 and he's paid $2.93.
Fastest fingers first.
How is that possible?
He says he has special friends. But you brought in the CEO, didn't you?
Exactly, yeah, and he's getting preferential rates. So yeah, down 7% today. Let's see how that goes. But we're ready for that bell, Angelina. Are you ready?
I'm ready. I'm so ready. Born ready. Right, here we go.
After their little holiday on Friday, who's feeling independent there? All those stocks are making some people independent of their profits. CrowdStrike down 1.7. Ooh.
Wow. Yeah.
Right, where is Tesla? That's the one that we want to see.
Yeah.
Whoa! Elon, how are you left?
Oh my goodness me. Woof. This is the thing. If he continues with this political stance, and that's what Matt and I were talking about, and you know, he's his whole retail cult following, right? And he delves deeper into what is probably going to be a very messy, affair. Does this mean that in that period, shares are going to be in for a lot of pain because he's now seen as taking his eye off the wheel yet again?
Off the wheel, very good. Like that. But I mean, we see the volatility in Tesla's incredible, isn't it?
It is incredible.
I think when we started doing this show, I said I stay away from this as much as I can.
Yeah.
And I definitely don't think I've made money in Tesla over time because I was always the big bear. But it certainly gives trading opportunities.
It does. And especially for those intradays. I mean, take a look at this. I'm going to whack up my chart there. That in the oval area that I have highlighted for you is the period when we saw, that bromance blossom. And then we had, it coming back down. And then we had, it was affected like everyone else with the Trump tariff tantrum. And then it's creeping back up again. But there's a huge amount of volatility here for those that trade, intraday, day traders, even regime traders. this offers a lot of opportunities. But I know you don't like touching Tesla. You've always said this.
Yeah, because
It's your kryptonite, isn't it?
It's so unpredictable that I don't feel you've ever really got a grip on what's going on, because it's not a car company. There's no way you can call it a car company when it trades on the multiples it does. Whether it's people buying into Elon.
Yeah, Pierre says it's a space Starlink company. That's his
Yeah.
view.
And I agree with all the robotics and the autonomous driving and everything like that. It's, you know, it's an incredible opportunity. But, you know, one single man risk is huge. And you just don't know what he's going to do next.
Yeah.
Or
You're totally
tweet
right,
next.
because it's unhinged from fundamentals when it's tied to one man, right? And we have Dan Ives, veteran tech analyst that covers this stock really closely, saying, you know, Musk is its biggest asset, right? Its biggest asset. And his decision to dive even deeper into politics is probably going to put the company's shares under pressure. You know.
Something about Sherlock. Right, so what are we seeing in this, my second tier of stocks there, MicroStrategy 404. We see, I don't know why I've got Beyond Meat up there. I just think it's quite funny to watch, you know, a stock so detached from the actual movement of what it was trying to do. But you see on the downside, Plug Power down 1.3, Taiwan Semi down 1.1, Micron down 1, Upstart. I heard about a few new stocks in a wonderful podcast yesterday, Angeline. And now's maybe not the time, because I know we don't have too long. But yeah, great podcast yesterday. Josh Brown is away, so they still went ahead with Compound and Friends, but it's Michael Batnick who you've got to laugh. If you're stressed, you do not want to listen to this podcast, because he is so hyperactive. I reckon he has about 5 coffees before it. But he does have a couple of... What's that?
That's one more than me.
Well, yeah. He's got a couple of guys on there, which really interesting this week. One of them talked about the S&P trading at between 28 and 30 times earnings. It was a real bull, the dream of the bulls. The 3 guys, all super bullish, all sitting around just, you know, talking about how AI is going to take all these different stocks to new levels.
So they think
super
the
levels.
S&P 500 is going to continue just marching
Oh yeah,
higher.
yeah. These are also the ones that are crying when on April the 7th, April 13th, they did and they like literally they were crying and begging for it to stop.
Interesting stuff, because you've got a short on, haven't you?
Well, I am short calls on the S&P 500. So they are December. The vast majority are December. So what I am relying on is that at some point in the next 7 months, we see weakness in the S&P. So I get paid time value every single day. What absolutely kills me and will be horrific is if we just continue up, and if we go to 6,800, 7,000 on a daily, that will really hurt. But if we get one single sell-off, then I'm golden.
You're good.
Yeah.
Yeah. Andrew McKilvey, you're asking for upgrades and downgrades in the last couple of minutes. We've got Pernod, Bernstein cutting the target price to 148 from 157. Relics as well. UBS cutting price target to 4,500 from 4,700. SAP, one last big one. Target price being cut by UBS to 300 from 307. So.
Right, here's the podcast I'm talking about. So when will the AI bubble pop? And it is episode 198 of Compound Friends. Michael Batnick joined by Joe Fahmy and Shay Balor to discuss where we are in the market cycle. They think we are in year 2 of a 5-year bull market. The outlook for AI stocks, really useful actually. They go through the whole spectrum of those stocks. So in the last 25 minutes of the pod, it's all individual stocks, a little bit like Piers, who is coming back on Wednesday, exactly, 9:30 on Wednesday. They talk about how Apple got left behind, the next Mag 7, and the bull case for Tesla. So that's a good one to listen to. Josh Brown's on holiday, Mike Batnick, incredibly annoying, but still possible to listen to. Now, talking about Piers, there are my trades for our good friend, what he had to discuss the other day. I have sold the October 185 puts. That paid me $4.10. And then I invested that in buying a 215, 240, 1/2 call ratio. Right, so all that came to, I think I paid for about 50 cents for it.
Nice.
Yeah.
Nice.
Maybe a bit less. Yeah, about 70 cents for $25 of upside in Apple. And then Intel not going well. Intel's not been a good call from Piersey yet. He did say it was a long-term one though. And just get those off. You can see my Intel selling a whole heap. You can see a whole heap of 19 puts I've sold there to buy the 2334. But as you can see in this size, that one's a lot more risky than the Apple one because I've gone a 1/3 on the upside. That saying, I do not think Intel will go above $38, where I would be incredibly short. Certainly doesn't look to be a problem with the way it's gone so far.
No. You did say this was going to be a one that you had to wait on for a bit to play out.
A 12-month trade, exactly. So I've played it till October there. And then anybody interested, what else I've got on there?
What have you got on Starbucks? I'm interested.
Starbucks is from a gent that I used to work with, Dipesh, who is incredibly bearish on Starbucks. And so I've got an 85-70 put ratio on there. So that's saying I get short at 85. We think they go down 20% on a profit warning in the next 6 months, but not below 70 because you still got the brand there.
And that will give the new strategy enough time to kick in as well, because now they're trying to go back to basics, right?
Yeah.
After all that time of ignoring every single shareholder saying, what are you doing? You're taking away humans from your baristas and making it all completely non-human, which is what, with bad coffee as well. So they're going back to basics. It is rubbish coffee, says.
Well, that's my, I will actually have to go and try one.
It's so bad.
If I, yeah.
And in the US, the Starbucks was horrified. They don't even bother picking up a pen to write your name. They get a computer thing to spit it out, and it just sticks your name onto the side of the cup, and they leave it there just to rot in the corner.
What name do you normally use?
Sam, because I don't have to spell it, right? Everyone does. What's your name, Sam?
But then, do you ever forget when they call it out?
No.
No, okay.
Pelican saying good morning, Scottish man.
Thanks
Angela,
there.
producer. Good to see you.
Top of the morning to you, Pelican. And now, where's Mango? We haven't seen Mango for a while.
I know, right? Where is Mango?
Check in, Mango. Say hi.
Waka Waka also.
Our biggest bear. Well, he's not happy because it's all-time highs. He'll be there.
Are you listening, Waka Waka?
Ah, yes, the old like and subscribe. We would ask everybody. It's a Monday. Mondays are very important to us because we have our meeting after the show. So a whole heap of thumbs up would stand us in very, very good stead with Sophie, because Sophie was at Wimbledon yesterday.
Yeah, wow.
Yeah.
Good weather. Well,
Sent to court.
nice. She is into her tennis.
She's going to be hating me right now. Morning, Sophie.
Sophie. Just very quickly as well, just also look at the shorts page just very quickly, because and this lines up with the podcast you were talking about earlier on.
Who's that Wally in a hat?
We have Scottish man in a hat, so please have a look at that, because the Bank of England does need you to design those new banknotes, right? Give your ideas. Also, if you enjoyed Joachim's interview and want to, get some snippets from what he said, if you are a day trader, a regime trader, and want to know why it's going to be tough for the S&P in the next 2 to 3 months, have a look at the short space, where I also have a lot of candlestick 101 early beginners tutorials for trader friends who've asked for it. And we'll get Bill Blaine back as well. The other Scottish man.
I hope so.
The other
He was
Scottish
brilliant. He's one of my favourites so far. Right now, Pelican is talking about Trade Desk, right? Trade Desk. This is one I don't actually know, but from the 1st of July, Citi raised their price target for Trade Desk to $90 from $82. That survey saying they're the clear market share leader and best performing demand side platform across inventory and data. Do you know this stock, Trade Desk?
I don't know this at all. I've not.
No, Pelican, tell us more, because it's had a nasty couple of days there. Yeah, maybe Dylan's heard of it, but should we get Dylan on and ask?
Yeah. Is he on right now?
Wonderful. Right, I shall do a runner and let Angeline chat to Dylan.
Yeah, Dylan's coming right up and find out why he is going to talk Palantir, as well as Tesla, and also Meta and Bitcoin, I think.
Now, if you don't subscribe, you'd really help us out if you hit that subscribe button. I know it's boring for the rest of you that are subscribed, but give me a break. Come on, give me a break. Hit that subscribe button. Go on.
And also, then you get to get your friends, invite them, because you get to email us at ask@ig.com. And producer Phil and I have had a segment where not only do I answer it after the show, but we also unveil it during the show, because this is for the community. This program is for you guys. We don't have any commercials other than Rich and myself on it. We don't get paid for those commercials and things. So please do spread the word.
Now, to give you an idea what's coming up the rest of this wonderful week, we got Graham Dickinson, a client of IG, coming in tomorrow. That's from about 9:05. Then we've got Alice Tapper coming in on Wednesday. Alice runs. Anybody who remembers Simon Mayo Confessions on Radio 1, Alice Tapper does it for Financial Confessions. So that's going to be especially interesting. We have our good friend Piers Buckworth coming in on Wednesday at 9:30 as well. Nick Feingold is back on Thursday by request. We've had...
Yeah, and by request as well, Bill Blaine will be back with us, the other Scottish man, on Friday.
Oh, I can almost have a day off on Friday. Good stuff. Right, it's time for Dylan.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, the fittest, mentally the toughest, but the cash returns, that's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose. Hey, trader friends, welcome back. And we've got Dylan all the way from the line for you. Hey, Dylan, how's it going?
Good morning. Good morning. Nice to see you. You're looking well. You're feeling well, I hope.
It's great here. We had an amazing weekend, and then we also had some rain. As you know, it's been super hot here. And so the rain is very welcome, I have to say.
Absolutely. We had the same thing here. We had a super blast yesterday of 10,000 liters in 1.5 minutes. Very exciting.
My goodness.
But
drop
the temperature. Drop the temperature.
Yeah, drops the temperature. I would love to kind of have witnessed that, because Milan for me was just, and I can't complain, but it was like hot, hot, hot the whole 5 days when I was there.
Mamma mia. It's been like that for weeks. We're suffering. As they say in Milan, you say, Madonna, Madonna, caldissimo, caldissimo. But it's the price. It's the price of the life. The good life doesn't come cheap, as you know.
It doesn't. And Dylan keeps telling me, trader friends, come to the light, Ange. Come to the light. Don't stay.
Speaking of which, look at this light on my head. I look like I'm here. Let me see if I can get some weird light. Speaking of which, there you go. You see this? It's like God is trying to suck me into heaven. I'm sorry. Into the ether, just like the light that are on the shoes that you've just launched. Wow, what a thing.
Let's whack up the Instagram that I've got here. Let's have a look there. And this is the page that you guys need to look at, because Euphoria is now live, people. And
2 weeks old, 2 weeks old, fresh out of Paris. Sneakers Euphoria on Instagram, and you can see it's listen, the team is great, the product is better, and everybody's excited to start making them available come September. So it's pretty cool.
Yeah, it is pretty cool. And also, when are we going to be able to hit the buy button? Please do. Here in London, especially here in London, is it delivered straight to your door?
Just delivered straight to your door. Pre-orders available now at Euphoria Sneakers. But the thing that's most interesting for the trader friends is that the company's logo is based on the golden ratio, which is the underlying ratio. It's also the Fibonacci sequence. So we're going full Fibonacci over here. They're sneakers for the Fibonacci crowd.
Nice.
So anyway, it's very exciting. So and everybody's having a good time with it. So and like I said, the Italians make a fine shoe. So we shall see. But let's talk about the madness.
Yes, let's talk about the madness. Speaking of fine, shoes to fine, markets. Boy, it never ever seems to quieten down. Now we've got a new date for those tariff deadlines. August 1st is the new deadline now. Plus, we also have a lot of focus on, of course, Elon Musk and this new party. What do you want to kick off with first? There's so much out there.
I mean, I think you got to talk about Elon and the political party. American politics have been so here's a brief history lesson. 1896, William Jennings Bryan. Before 1896, voter participation in America was 80 or 90%. In the election of 1896, there was a big betrayal of William Jennings Bryan, who had a third party The Democrats convinced him to shut down his third party and join the Democratic Party and adopt his platform. Then the Democrats obviously did none of the things that they said they were going to do. And at that point, it was the beginning of the alienation of the American voter. Since 1896, half of the eligible American voters never participate in any president and any election because they believe the entire thing is a scam, a sham, a ram, whatever, an illusion, a falsehood, a BS, as they say in the streets. And so America has been suffering from very low levels of voter participation now for, how long is 1896? 140, 130 odd years. So it's been a long time. And the voter participation only gets lower. Political activity only gets more extreme. Lots of folks have tried to start third parties. There was only one successful third party in the history of America since 1896 in William Jennings Bryan, and that was a gentleman named Ross Perot in 1992, who mounted a genuine, he took a third of the vote. However, because of the success of Ross Perot, really the two political parties since 1992 have locked in a coordinated effort to make sure that there's never a third-party threat ever again.
So it's only just two-party race.
That they listen, it's either you or it's me, but it's never going to be them.
Yeah.
And so this will be super interesting. I mean, obviously, it's all a long shot. Musk has a unique position because he has so much money, obviously, and so he owns both one of the biggest social media platforms, and he's stinking rich.
So much media clout as well.
But we've also seen Mike Bloomberg try, not a third party, but money alone. So the thing with politics that's different than finance or commerce or anything like that is it's really more akin to religion than it is to any sort of logical action. And so starting a new political party is more similar to starting a new religion. You can be Jewish, you can be Muslim, you can be Christian, but if I start Dylanism, that's even if I'm the world's richest man and I'm a Dylanist and I believe in shoes and I believe in tasty trade and I believe in, whatever my things are.
Which brings me to the fact that I think, because it's a tough battle, even for someone like Musk, right? Does that mean, Dylan, that really essentially what one as a trader, investor should read from this is it's just going to be a really rough ride for Tesla shares for the next couple of years?
I don't think so. I think that whatever happens with the Musk political party, there may be moments where it creates sell-offs in the stock, but I believe every Tesla sell-off is a buy the dip. If anything, I would say that the Musk political activity, you should be so lucky that the Musk political activity actually creates some selling in the stock as an opportunity to get it. I know that there's this huge correlation between Elon and the stock, but I also know that Tesla is a sensational group of some of the world's preeminent engineers, and they're now one of the preeminent auto manufacturers in the world. They deliver good cars. They do it on a regular basis, and they are probably the most innovative outside of China of anybody doing development in what I think is the biggest growth sector in the world the next 5 to 10 years, which is transportation technology. Tesla is not just about their cars. Tesla is a world leader in software, logistics, and infrastructure for transportation technology. And owning that stock is not just a multiple on the gross margins of the discounted value of future electric car sales. It is a referendum on the future value of transportation technology.
That's right.
And I can't think of a better business that's well positioned. I mean, there's obviously other ones like Uber and Waymo and some of these other, Google obviously is well positioned for transportation tech. But boy, Tesla's really well positioned. And I actually think Musk's sort of boondoggle into the political universe, if anything, is going to create an opportunity.
So what you're saying is that move much lower in the all sessions. I'm going to try and get my chart back up here for you guys. Here we are, all sessions. It's now down 7%. This is a buy. Yeah, this is the buy the dip. It keeps moving back to the weekend. I have no idea. This is a buy the dip opportunity. And what you're saying there is also
at the very least, at the very least, some put spreads with a decent margin of error underneath this thing seem to be a very reasonable consideration. I'm not saying you need to get nakedly long or even buy calls, but for sure, I think to nibble on some put spreads, one standard deviation below the current level warrants serious consideration, in my opinion.
Cool. And of course, those watching that have Tesla in their pension portfolios, keep calm and carry on is the message.
Oh yeah, for sure. I mean, it's not just the car sales. Don't forget the incredible power of transportation tech over the next 5 years.
Right. Cool. And then you have several others as well that you are saying, risk on. You have Palantir, you got Meta, Nvidia as well. Let's have a look at Palantir first, because we've got many trader friends here who have a position on Palantir. Here we are. Palantir also all sessions up around almost 1% there. However, Palantir has had a rip-roaring run since, recovering from April 4th or April 7th, thereabouts. And it has moved strongly higher. And you think it's still completely risk on here?
Well, I think two things. One, outside of the traditional U.S. defense contractors, specifically Lockheed and Boeing, there is no better positioned defense contractor on earth than this company. That's obviously part of why the stock looks the way that it does. Additionally, this name is coming off of, it's sort of in a hangover right now, or a little pullback from a profound piece of momentum. And I believe that the market is in a position where momentum is God, risk on is the underlying basis of everything, and Palantir is the shiny object, not just now, but for the duration of the Trump presidency. And so I would actually look at this much like Tesla, where the pullback here is a huge opportunity to get into something that is driven by a central position at the Department of Defense as the contractor of choice for the future for the robot military and for surveillance, and is also is almost a meme stock. I mean, it has the combination of strong fundamental support by virtue of its position as a defense contractor and really strong social and sort of market support because of how widely followed, believed, how much hype there is around the name. So again, this is one, same as Tesla, put spreads one standard deviation below the level seem very reasonable to me.
And Palantir as well, not just like a meme stock, but also it's got its tentacles everywhere, right? Everywhere. It's not just defense and space, but their software can be deployed anywhere. They've even got AI software deployed for nuclear construction, and it's one of those that I kind of think, if you chose your portfolio like a football team, right? This one is going to be one of your main players.
100%. And I think that we've been distracted by, there's obviously such a focus, the AI focus had everybody sort of sucked up into NVIDIA and Meta and for that matter, Google, OpenAI, all that whole AI discussion. But I think that, whether it's transportation tech on the Tesla side or defense tech on the Palantir side, you are a fool to not be involved with these names, especially when you get these pullbacks, especially because they tend to have good volatility, and especially because they're highly liquid, and especially because you can basically do a risk-defined put spreads on these pullbacks and have a reasonable probability of profit. And I just think that all warrants meaningful consideration.
Have you read, Dylan, about the mobile Iron Dome?
No.
If you haven't, you should read it, because it's all about how Palantir and Tesla are stocks that kind of go together, because Starlink and all that technology, plus Palantir's technology as well, means that in the future you can have mobile, so movable iron domes due to satellite technology. And it doesn't have to be in one place. Like, it doesn't have to be, something that is tied to Israel.
It's like a pop-up.
Yeah.
It's like an Iron Dome pop-up.
I like that. I'm going to steal that. Iron Dome pop-up. That's way more sexy. Speaking of which, we've got Phil in my ear. What's up, producer Phil? So I am being told to look at my teams. Is that because I have a Very important question. Please give us a disclaimer, right? So this is great because obviously this is not advice. This is not advice at all. This is just a discussion, and Dylan's views are Dylan's views. And also, as we talk about, some of these themes, these are just themes that are already out there on the internet. You can easily find them. So it's up to you to do the research and come to your own conclusion. There are many ways to, look at investing in this space. We're just highlighting some of the spaces. Right. Blake 7 coming online saying, what cars are to Tesla and what books were to Amazon? I think that is a good point. That is a good point. Let's move on to another one. NVIDIA, you were talking about this earlier.
I think you can stop. I think that's a really good point, and it's worth stopping for a moment. Imagine valuing Amazon based on book sales margins.
Yeah.
I mean, there's a reason the Tesla multiple is so much different than the Ford Motor Company multiple, and it's because they're not trading on the discounted value of the margins of future car sales. They're trading on the discounted value of being the world's dominant transportation technology company, full stop. And the same way Amazon. I mean, anyway, that was just a great comparison. Sorry, we're moving on.
Yeah. And just really quickly, we're running out of time. Do you have a quick word on NVIDIA before we go?
I mean, I just think that, the AI thing is not going anywhere. The rate of change in AI is at an all-time high. All of us, I think, are using it more and more, but every time I use it, every week I use it, every day I use it, it is more profoundly inspiring, insightful, et cetera, et cetera, et cetera. And so I just, NVIDIA is less interesting to me from an investment standpoint because there is no pullback in it. I mean, the chart kind of speaks for itself, but it's just another one that can be, I would look for pullbacks. I like Palantir and Tesla because they're giving you some of these windows. Just my opinion, not advice. Tell the lawyers. I don't mean anything by it. But whereas NVIDIA, I think, needs to be constantly monitored for the pullbacks, which are, I think, out there somewhere, and it's just a matter of making sure you don't miss them.
Great. Thank you very much. Do hit the like and subscribe button. We have coming up next, Axel on Trade of the Week. So any questions for Axel, do slam them right here or send them across ask@ig.com. Dylan, have a fabulous week. We will be speaking with you offline, but thank you very much and congratulations on Euphoria.
Thank you. Have a great day. Have a great week. I'll miss you guys. Can't wait to see you sooner than later, okay?
Okay. Stay right there, trader friends.
Bye, trader friends.
There are certain things in our daily lives that everyone has a view on, like your favorite clothing brands, supermarkets, or even which airlines to fly with. Maybe you're loyal to EasyJet and you think British Airways seats are too expensive. Or you'll never shop at Tesco's again because Marks & Spencer's food offering has won you over. Now, what if you could use these views to try and spot opportunities in the markets? Let's talk about pair trading. It's a way to trade that focuses on the share price relationship between two similar stocks rather than taking a view on the market as a whole. Here's how it works. Take Nike and Adidas, for example. Now, some people think that Nike has gone out of fashion recently, but maybe you believe in a brand recovery over the medium term. On the other hand, Adidas Samba and Spezial shoes have been incredibly popular recently. But have sales peaked with this trend? As a trader, you could go long on Nike, expecting its share price to rebound over the coming months. Also, alongside that, you could go short on Adidas, expecting it to cool off after its big run in the last 12 months. It all depends on how you would like to express your own personal view on two companies. But keep in mind how quickly trends can shift. Remember when Under Armour rose to popularity fast, along with its share price. But then they spent most of their profits on celebrity partnerships and their share price performance flopped. Now, this doesn't just apply to clothing brands. Think of Tesco's and Sainsbury's in the supermarket space. Two companies that often move together. Now, if one outperforms the other unexpectedly, pair trading could let you capitalize on what could be a short-term difference. Because the beauty of pair trading is that it's market neutral. If the whole market drops, as long as the gap between your chosen pair narrows, you could still see an opportunity. But don't forget, always research why prices are diverging so you're not caught out by unexpected trends or their financial results. Do you want to give pair trading a try? Start simple. Test it out on a demo account first. It's a great way to learn the strategy without taking on real risk. And on IG's platform, you can explore similar trades easily with access to the tools that you need and further education on the IG Academy.
Hello and welcome to Trade of the Week on Monday the 7th of July 2025, and let's look at a trade straight away, which is to go short Euro Sterling. So sometimes it makes sense to look at a longer term chart. And why am I saying that? Because here you can see the daily chart, and clearly we've got an uptrend in Euro Sterling. So why would you like to sell it? Well, basically, if you go onto the weekly chart, and you go all the way back to the high seen in September of 2022, you can see that we've got this tentative resistance line not far above where we're trading at the moment. But more importantly, what we also have, going back to last week's high, can you see here where we're trading at the moment? If you go to the left, it's slightly above the August 24 high. It's around the April 2024 high. Is slightly below the highs going back to December 2023, and also the highs here, July 2023. And as you know, I love clusters. So if you've got previous weekly highs, monthly highs, going back many years, then there is a very high likelihood that that area will act as resistance. And if you also have a tentative, or even better, a proper trend line with 3 touching points in that vicinity, then we could see a reversal of the trend happening. And you can see something like this happened back in, it was April of this year when we had this ABC correction to the upside, and then we drifted back down again. Currently moving up, we've had what I perceive to be 5 waves to the upside. So we're also getting from a wave count back towards the sort of end movement. My count might be incorrect, but still there's a lot of resistance in this area. So from a longer term play, what I would like to do for purely technical reasons is to go short Euro Sterling, probably around current levels, let's say 86.39, where it's trading at the moment, with a stop loss above not just this high here on the 11th of April of this year. Why not just this one? Because basically you can see here, if we go further up, you've got a higher high, which is for the highest one after a long candle here, which was made in April of 2025. Sorry, so that is actually the correct one. So a stop loss above here. Oh yes, I know why I wanted to say this, because this high here basically is slightly below this high here going back to November 2023, and that was made at 87.69. So for the sake of 30 pips, I'd rather have a higher stop loss where I had 2 weekly highs being made here, which may be, together with this high here in April 2025, a good resistance area. So basically, the trade of the week is to short Euro Sterling and have a stop loss above 87.70, and our downside target probably around the 84 area. But this is a long-term trade, so over the summer, etc. But what I also would like to mention very quickly is the previous trade of the week, so the one from last week. And what we can see here, we went long here on Monday, the 30th of June. We did so down here around 3,000, let me just check exactly, 3,285. We had an upside target in place around 3,400. Didn't quite reach it, but we can see here we had a really nice profit within 3 days. So that one for me is considered to be done. And as I said before, this is not trading advice. These are just setups that I show you. I don't trade any of these personally, and neither should you. You should do your own research. But I'm showing you setups, and that's why, you know, targets might be there, but they may never get reached, etc. And the same happened to dollar yen from a few weeks ago. We went short dollar yen on the 23rd of June, and we did so up here somewhere around, I believe, 147.50. I had a downside target, a longer term downside target around 140, but probably I would have now been out of this trade because, you know, we went all the way down to this support area here around 143, maybe 144. So if you're still short from up there, just lower your stop loss to your entry levels. You've got basically free trade on, because the current counter trend move to this downtrend might soon fizzle out, and we might go back down again over the long term and perhaps reach that 140 level I talked about earlier on. Right, I haven't heard anything from the gallery, so I suppose I'm on Technically Speaking. Hello, welcome to Technically Speaking. We're back, even though we've never gone away. Right, okay, so loads and loads of questions. I love this. And let's start straight off with, I've actually got too many probably for this show, but let's look at the interesting ones, and then we go into the more, less well-known ones, shall we put it like that. Those seems to be the trades that some of you have on, and you want to know what we can see technically speaking. So again, this is not trading advice at all. It's not investment advice. It's just looking at charts. It's information that you can freely look at yourselves. And we just look at how we would snapshot a chart technically from a technical perspective and see where we're at. So here we've got, talking of snapshot, snap. And snap in the US, this is the monthly chart, has had a difficult time. As you can see here, it's come all the way down from its September 2021 highs, and then has been trading more or less sideways for a very long time on the monthly chart. That just tells us that we are in a sideways trading range. Not much going on there. If you then go to the weekly chart, because we always want to go from the longest term chart to the shorter term time frames to see whether we can draw any trend lines on there, any resistance lines, have previous highs and lows, tell us where resistance potentially is, look at support and things like that. So here on the weekly chart, we can see we've got a tentative downtrend line between the highs seen in February 2024 and those seen in July of 2024, but that line is a long way away from current levels. So I want to draw an internal resistance line with the next lower high here. That's also a little bit further away, but it does give us a potential upside target area. So that could be something we could be looking at if we were to continue to rise with regards to Snap. Now, if you look at the Snap share price, what we can also see on this daily financial bet is that last week we came quite close to the highs seen on the 28th of April, this high here on this big doji. If we manage to break through there to the upside, and you can see here I've also got my 30 period simple moving average up here, which also acted as resistance, this little green line here. If we can manage to rise above both of these, last week's high, the 30 period moving average, the high seen on the 28th of April, which on the daily financial bet was made at 987.5, then I do think we may hit this downtrend line, this tentative downtrend line. And also that is an area around there where you have lots of previous lows. So that could be a good resistance area, let's say around $1,035 to $1,039 or so. So let's look at the daily chart. What we can see here is clearly on the short-term daily chart, a breakout of a short-term downtrend. As you can see here, we've got this resistance line here. We rallied above there on Friday, the 27th of June, closed above that resistance line. But as you know, what I like to see also is not just the trend line breaks, because as we know, trends become flatter quite often anyway, and it doesn't mean it's a trend line break. What we want to look at is we go to the left of our chart and look at the previous relative high. A relative high, those of you who watch the show regularly will know that a relative high is a high on your candlestick chart, on your bar chart, whatever you're looking at, which is higher than the one on its left and it's on its right. And that was made on the 11th of June. And here, Snap was trading 894.5. So a close above here on a daily chart closing basis, which finally happened on the 1st of July, that here is bullish. And you can see the candles were also green and longer than the bearish candles here. So something seems to have changed with regards to Snap. Now, we have encountered that resistance area I told you about. So short term, we might come off of it, but perhaps any retracement back to this high from the 11th of June could be seen as an opportunity to enter this trade from the long side, from a technical perspective. Where's your stop loss? Well, where's the last important relative low? It's this low here. So that would be your tightest one on 23rd of June low at 775.5, just below there. If you can afford a slightly wider one, can you see this low here after this long candle to the downside? That was made here on the 30th of April. So you could have that as a stop loss for a longer term, medium term to long term position if you wanted to go long Snap. If you go short Snap, well, you know where your stop loss is. Can you see all these previous highs? I told you about this end of April high, these highs here. So longer term, it would be all the way up here above these highs going back to February of this year, but that might be a bit far away. So I would probably, if I'm short, place my stop loss either very tight above the 2nd of July high at 962, for example, here above the last reaction high, or if you have more space with regards to the risk that you're taking, then probably around the 29th of April high at 987.5, just above there, because that was a big reversal. And then we had this reversal to the downside. So that's more important than a short-term top like this one. So that's Snap. Let's look at another one. Let's look at BRB. I'll probably have to go through these quicker than I have been doing right now because there are so many different questions you have here. So Burberry's, let's look at Burberry's. Burberry's is looking good. As you can see, we have an uptrend. Longer term, what we've also seen is a breakthrough, a tentative downtrend line. That means only 2 touching points here. That's the monthly chart going back to 2023. What we've managed to do is break through here. But as I just said to you on the Snap chart, what I also want to see is a close above the previous reaction high. And that was made back in February of 2025. Here on the Burberry share price, that was 1,254.3 on the daily financial bet. What we want to see at the end of this month, so end of July, is a close above there. Then technically speaking, what we would have formed as a bottom here, a double bottom. Can you see that low is more or less where the previous low was? And then the breakout to the upside would take us, it would take this distance here from the low to the midpoint, projected higher. That would perhaps take us, with regards to the Burberry share price, all the way back up again towards 1,800 or so, or even higher than that. So that is a long-term possibility, technically speaking, but we need to close on a monthly closing basis above this February high. So what do you do? Because you can't wait until the end of February, end of July, for example. You might not want to. So if you look at the weekly chart, did we have a close above these previous highs? Yes, we did. So you could argue, I don't need to wait for the monthly chart because I did have my close here at 1,254 last week, which was above the February high or just around there. So that you need to, what was the close here? The close was actually 57 and here the high was 54. So yes, you had a close on a weekly basis above that high. So that to me means that it's very likely that we've had a valid double bottom forming here and we could continue to go up. Where's your stop loss? The last reaction low here on the weekly chart. So that's probably around 985 or so. 23rd of June low. You'll see that 23rd of June low, we creep up a lot on all of these charts because that's where the last correction low was before we headed high again with regards to US equity markets, for example, as well. So you can see here, any retracement back towards the 1,140 area here, these highs going back to June of this year, could be a buying opportunity from a technical perspective. If you're short, have a stop loss probably just above the highs seen last week because that's the last reaction high. Because if we break above there, it's pretty likely it's going to continue this uptrend. But yeah, we've got an uptrend on Burberry's. Let's have another look at SNX. I guess it's this one, Synthetics PLC. Actually, before I cover the incorrect one, could you please let me know Neil, which one you want me to look at out of all of these, and get back to me. Just let the gallery know. In the meantime, we'll look at another one, which I honestly, Xpeng, don't know much about. And you can see on the chart maybe why that is. Can you see here? It trades in the US, but it must be an Asian stock, I guess, and basically we've got lots of gaps, etc. So chart analysis with a lot of gaps is always more difficult because you haven't got this fluidity you've got on the other charts we just looked at. But if you look at the trends, they're still the same. So I connect the highs together, I connect the lows together. We can clearly see we're just in a sideways trading phase. But that on the 30th of June, we basically bounced off that low here from the 21st of April. So we've got support here. We're trying to go back up again. What we need to see now is a rise above not just the 30-period moving average, but the last reaction high, the 24th of June high. If we manage to do so, we could then test this resistance line and then break above this previous 11th of June high and then go higher again. These are just scenarios. In the meantime, what are we actually seeing? Because it's great to project something onto your chart because that's what you want to happen, but the reality might be totally different. And the reality is different, as you can see here on Xpeng, because what we can see is that every time we test this tentative downtrend line, the steeper one, that acts as resistance, we come off again. So we may very well see this happening this week. So maybe if this resistance caps, we could retest that or lower support area. We're at 1,800. So right now, sideways trading. I'd be cautious. If you want to go long, have your stop quite tight below these lows here and the lows seen, I would say, on the 21st of April. Again, I'm not giving any trading advice. If you're short, just have the stop above these recent highs because that's the resistance line. If you want a wider stop above the 24th of June high and you continue the trend. So that's probably the way I would look at it. But I've done a very, very cursory analysis here and I wouldn't reach too much into it because basically, as you can see here, we're just trading sort of sideways. It might not always be very good. Let's have another one. QBTS, D-Wave Quantum. Now this is interesting because in the monthly chart you can see a huge up move in May, went up to new all-time record highs. And if I now go on to the daily chart, what we can see here is a consolidation phase after a very strong up move. Now this is normal price behavior, so I wouldn't worry too much about this. But if it drags on, it is perhaps telling you that your upward moving trend has changed into a sideways trend. And this may be the case here with a slightly bearish bias because what you can see here on D-Wave is this strong up move, this corrective move down, but then we had another move down to the low seen on the 27th of June. Now we're trying to go back up again, but we've got this tentative resistance line just slightly above us around 1,700 in this daily financial bet, which we need to take out for us to head to the next higher high here, the 9th of June high, which is the last reaction high. If you go above there, it's very likely we're going to continue with this up move. Now, how do you measure that? Well, if you have a previous up move, corrective phase, and this is sort of a flag pattern, it depends what it will turn out to be, then you can project the distance of what is called the flag pole, this sharp up move here, that whole distance to the flag, and then you can get that as an upside target. So potentially you could go way above 2,000, etc. But right now we're still, as long as this resistance line holds in a short-term downtrend, even though in the very short term over the last week or so, we've had positive momentum take us to the upside. So again, you know where your stop losses are. If you're long, probably the last reaction low, the 27th of June low. If you're short here, probably the high seen on the 9th of June, or if you have more space, probably the high seen on the 23rd of May. So that is perhaps a target. I've got so many here. I'm sorry, I won't be able to get through all of them. Let's just try and look at different sectors and do it this way. We needed a longer show in the gallery. We need a longer show. Archer Aviation. Basically, we've got, yes, what can we see here? Again, if I don't know about the chart, let's look at the monthly chart. Go to longest time frame you can look at, and you could see we made an all-time record high back in May, have come out since then, and basically we're trading sideways at the moment. Not much going on here. What you do is you draw on your resistance lines from the highest point to the next higher high, lower high, without any data going through it. You can see that that resistance line more or less acted as resistance at the end of June, beginning of July. We've come off again, and we're just trading sideways. So here, sideways trading, that's the last reaction low. If you are long, maybe have a stop loss below the 23rd of July. June low, again, I mentioned the same June low. If you have a wider one available, perhaps the next lower one here on the 5th of June. If you're short, your stop is probably just above the last reaction high, which is this one here, the 30th of June. But can you see that the high on the 25th of June is very close to there, very close? You just take the higher of these two and put your stop loss there if you're short. But always have a stop loss in place, because you might be wrong on your view, and even if you're right 3 or 4 years down the line, you could do far more with your money in the meantime. So just always take the first loss if it goes against you, because that's quite often the cheapest one. It's the one that's going to cost you the less mental stress and also money most of the time. Let's look at, to finish off, and as I say, I'm sort of apologizing. I had about, I don't know, 15 charts, and we can't just go through them so quickly. So let's finish off on Intel, and on the Intel chart, because basically that is a very popular stock. Let's finish up on that. What we can see is that on the monthly chart, Intel is still not looking great. Why is that? Well, what we can all see is we had this downward move, and then we're just sort of grappling with this support area here and just hovering above the low we saw back in April of this year, the famous Liberation Day US Trump low. And that here for Intel on the daily financial bet was made at 1,766.5. So if you're long, that is probably your stop loss, because that low ties in more or less with the low seen back in April of 2010. And that's what I just meant. You know, if you have a short-term position which turns into a long-term one, for example, imagine you bought it at 5,000. Well, you don't want to hold it like this. You don't want to go through that pain. Just take the first stop loss, have your stops in place, start again, look at something different. Believe me, it's much healthier for you and also for your portfolio. Anyway, going back to Intel, sideways trading range from a medium-term perspective, monthly chart definitely sideways, weekly chart, as we can see, a sideways, daily chart. We see a little bit of change, but only very slight change, because basically what we're seeing is we're once again faltering at resistance. As you can see here, we are trying to break through this tentative downtrend line, which became a downtrend with 3 touching points here on the 10th of June. So we broke out of that. That is the first time we did so. And we also, as we did that, we closed above the previous high. That is a trend change, at least from a short-term trend perspective. Positive, isn't it? And then we went higher and we went above this high, stayed above there, but now we've come back down again. Is this negative? Short term it may be, but not necessarily, because basically what happens quite often when you break through a downtrend line, you retest it. And you can see that that was happening on the 2nd of July last Wednesday. Retest the downtrend line, that acts as support. Here in this case we didn't touch it, but that quite often gives you another opportunity to go long had you missed that break. So this to me is still constructive, and basically we could have another retest of the breach downtrend line, which is now, because of inverse polarity, a support line. If that holds, and if they take out the next higher high that we just had recently, 27th of June high, that for me would be bullish, and we would then probably have upside targets around the March high, which takes us back towards 2,620, and probably also the February high towards 2,736 on this daily financial bet. So for me, this trend line break is quite constructive, because we're trying to break out of the sideways trading range. Now, if I'm incorrect, this might still be a sideways trading range, and we just had a false breakout to the upside here for a few days, and we'll come back into the range. If that's the case, what's likely to happen is we're going to go back towards the green line here, the 30-day simply moving average, and just gravitate back towards that one and range trade around it. Where's your stop loss if you're long? From a longer term perspective, probably from a long term perspective, the low seen on the 8th of April down here. Again, the April low. From a short term perspective, probably the low, because you want to give yourself a little bit of room here with the breach downtrend line. Probably the 13th of June low, 2020. Sorry, that was made at 2010, just below there. If you have a wider stop loss, you can use probably the low here at the end of May. If you're short, you know your stop loss is just the last reaction high, which could have been the fourth breakout. That is 2,338. That would be a stop loss in case of being short. Thanks for watching. Technically speaking, sorry that I could get through all of your charts. We will just send them to me again, these questions, and I'll look at them next time. Thank you. Bye.
We have a trade deal. It's Wednesday, July 2nd, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Thomas Westwater in Chicago to start the show. Dylan Radigan should be joining us shortly. We're here to take you through the rest of this hour as we wrap up the trading day. Futures market closes at 5 Eastern, 4 Central. If you're on the platform, Tasty Trade, on the website, tastylive.com, welcome. Thanks for joining us. Come over to YouTube. Tell us what you think of these markets. When you think of these markets shrugging off a huge decline in Tesla sales, not as bad as expected, maybe a miss on ADP, appetizer for the non-farm payrolls report tomorrow, doesn't matter. We have a trade deal with Vietnam. Retail stocks doing quite well today. Nike taking another leg up, Apple taking a leg up. It's a good day all around. Nvidia trading higher as well. S&P 500 very close, just so close to an all-time closing high here as we turn our attention to these charts. We're looking at a close for today of 62.75. Thomas, earlier on Futures Power Hour, we noted that the high was 62.78.75, so not there quite yet. For the NASDAQ, it's a resumption of where we were basically to, well, start the week a little bit higher from where we began the week. But racing yesterday's losses overall, a modest session, light volumes, low volatility, continued push to the upside. The big mover, of course, in the equity market is the Russell, which is up by 1.41% and closing at the highest level we've seen here in the RTY U5 contract since March. The cryptocurrency space had another good day where Bitcoin may be breaking out, and we'll have to get to that shortly. Of course, in bonds, we do see a bit of a pullback as Trump's bill meanders its way or snakes its way through the Senate and back into the House, where they are still voting on a resolution, whether or not it can make its way to a full floor vote. That vote's been open for about 2 hours, which is unusual, so to speak. But we'll watch that here during the show. Gold, but silver and copper more so, breakout. And a mixed day for the dollar, though good news for Ilya and his short British pound position. As we started off with the day with a market that was looking a little bit weaker, but as the session goes on, stocks firm up. Thomas, I already had a chance to speak with you earlier. So Ilya, before we hand the mic back to Thomas, give us your quick, 1 minute rundown on this equity market move on this NFP Eve.
I mean, probably the most interesting thing here is just the market's sort of autopilot disposition here. It doesn't look like there was anything that really nudged them this way or that in particular. I mean, ADP came, nobody really paid attention. The trade deal with Vietnam, okay, yes, but it didn't really move the overall index in a decisive sort of this is the news kind of way. We're basically sitting at the highs for the year and almost like waiting for what the second half theme is going to present itself to be. And in that sense, the jobs data is, of course, very interesting. So it's almost like the markets are at a kind of starting line to kick off January again. We had our spook, sentiment has recovered, let's try again. And the NFP data is perhaps the first sort of opportunity to really get some second half allocations moving. Obviously, we can see volumes here are very, very low, so it's not like money is rushing to position for the next quarter or two. And so we then end up with this being kind of the first big tell. And as we've been talking about, the disconnect between stock and bond markets is what I'm most interested in, because the bond market is saying that inflation expectations are down, not up, and Fed funds futures are saying the Fed is going to do 120 basis points in cuts through next year, not 75. So somebody here is wrong, and we're going to get a chance to maybe see who that is with this data.
Thomas, we firmed up here a little bit into the end of the session. We're basically going into non-firm payrolls in at least the SPX. If you're looking at SPY as well, these are all-time closing highs.
Mm-hmm.
Do you feel different than Ilya does or than I do about tomorrow's jobs report? Because it seems that Ilya and I have a bit of a disagreement about the importance of tomorrow's NFP figure.
I think it's important. I mean, like Ilya said, there's going to be a theme for the second half of the year. It's, the Fed's going to cut. The economy's holding up just enough to avoid a recession, but keep profit margins aloft. Trade deals are now happening. So there's some exuberance. The thing that holds me back is this light volume, but again, that's to be expected during a short holiday trading week. But positioning-wise, I'm holding back. I'm long Tesla, but that's about it for equities. I'm waiting for volatility to expand, for the price to pull back, and then, getting more directional in this market for equities.
I saw an interesting stat earlier today. You mentioned sentiment. I think that's a point worth discussing. The June AAII asset allocation survey came out earlier. Just some of the top line figures here, and this is available from AAII. You can go over to their website right now. What do we notice about this? The stock and stock funds allocation is at 67.5%. That's above average. We see that bond and bond exposure is at 15.9%, which is slightly below the longer term average. And ultimately, cash is basically down 3 points. That's 16.6%. That is below the average. So to a certain extent, it makes sense. If the market was in a chase mode in, we'll call it the second half of the second quarter, trade agreement framework reached with China in Switzerland May 12th and onwards, basically, the market goes into chase mode. It still feels like we're very much positioned in chase mode. And so this, in a certain sense, it's crowded. In another sense, we know where, futures traders stand, and futures traders haven't jumped on board yet. So typically you're going to see the, exhaustion type move once everyone piles in long. Thomas, while we have you here, just a quick look at what's going on in oil prices, because you are a bit of our resident expert. Crude oil's up 2.8% today, natural gas up 1.73%. So Natty's a little bit in from when you and I spoke earlier, but crude oil has extended its gains a bit more. Was there something in the inventory data today that helped spur this on? Something tomorrow that we're looking forward to?
Yeah, it was all imports. Imports increased a lot. Exports decreased. So that's why, you get this stock bill. And this comes after 2 weeks of heavy declines in inventories. We're still 11% below the 5-year average for crude oil inventory when you exclude SPRs. And today we're seeing, the backwardation is strengthening between the current contract and the next month's contract. So backwardated about $1.47. That's down considerably from, a couple weeks ago, but you had the geopolitical risk premium in there. Mm-hmm. So if you're looking at it from the beginning of the year, we were almost out of backwardation in February. And then all the way until May, we traded around 60, 70 cents. And then this Iran thing really jumped us into a steep backwardation. And now we're still fairly elevated. So when you're this backwardated in the oil market, it's kind of, some people see it as a proxy for physical demand. And that's kind of what you're seeing in the US with stocks 11% below the 5-year average. You got, earlier in the year, I thought there was an artificial, cap on prices from OPEC since they'd increased production. And perhaps we haven't hit that yet, if we will. I mean, we're only trading at 67. Myself, I'm long. I have the put spread on in oil at 61, 62. I'm going to keep that. And, you know, if I was taking a position today, I'd be slightly bullish. So trading up back towards the 70 level, I think. But, you know, a lot of this also has to do with the jobs report tomorrow. If we come in under, you know, that's going to spook the demand side for the market and perhaps push us back down.
Elliot, was there anything that you flagged in today's trading about oil, or is this simply just, as Thomas says, a story of inventories? Because when I look at the scope of today's data, I don't necessarily see anything super inspiring, even if I would suggest the market does have a growth tilt. Banks, industrials, consumer discretionary, copper, silver, the dollar fades over the session.
Mm-hmm.
It felt growthy. Felt like oil had enough of a reason to be there.
I mean, sure, but I think when you look at the price action, I think to Thomas's point, you got a kind of nudge with these inventory numbers, and that was really sort of intraday the catalyst. Now, it's always difficult to unpick. Like, did the market want to go higher and didn't because it obviously knows that on the calendar is this event risk, and it's going to wait to get to the other side of the event risk before doing what it was already going to do, just in case the number is something way off sides? Or was it the number that motivated the reaction? Ultimately, it doesn't matter. The market is telling you where it wants to go. But the trigger seemed to be these inventory numbers. And to Thomas's point, crude imports absolutely surged. I mean, we're looking at 2.9 million barrels, almost 3. That's, I mean, we'd have to go back 2 years or so to see something comparable. So perhaps there is a story of demand here, but not exactly even the numbers. I mean, obviously, you wouldn't expect if you'd get a 3.8 million barrel increase in overall stocks that prices would go up. But after the kind of declines that we've seen, you take that in context. In fact, the Challenger job cuts data was kind of a similar story today. We had the smallest number of job cuts for any month so far this year. But also, 2025 has had the most job cuts since 2020. Mm-hmm. And that's because they were all stuck in the first quarter, mainly in February and March. So to kind of see normalization at the headline of the inventory numbers, that's contextual. But that imports number is seemingly speaking to significant demand, because that's new. That's offsides. So maybe there's something here, and certainly after the kind of sell-off that crude oil has had, maybe it makes sense that sort of the path of least resistance is a bounce. But I agree that tomorrow's jobs report is a downside risk for this. So I'm not looking to be a buyer. I think the story that the bond market is telling us, the story that the disappointments in U.S. economic data has been telling us, all of that points to everybody but equities having sniffed out some kind of an economic downturn. And that's not a great environment for crude. It's just a matter of when the evidence appears, it seems like. So, and some of it has appeared already. So I think I would rather be using this bounce as an opportunity to sell, rather, not yet, but once it appears to peter out, rather than something I'm going to be chasing higher.
We're going to take a quick break here. After this, we're going to swap Thomas out, bring Dylan in. I'm going to make a case for why the oil move is why bonds are weaker today. Quick 90-second break. We'll be back here on Tasty Live. We're back. You're watching Overtime on Tasty Live. I'm Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan now in from Milan. Before the break, we were talking about how oil prices were pushing up today on the back of these inventory figures. I want to make the argument Ilya, the rolling 24-hour correlation, looking on a 1-hour basis between bonds and oil prices. Yesterday, at their high, when bonds were trading up at 116.03, the rolling 24-hour correlation between bonds and oil was literally zero, flat. Today at the lows, that correlation between oil and bonds was negative 0.79 on a rolling 24-hour basis. And that makes sense from our fundamental macro view. Higher oil prices, particularly those that climb sharply in a quick period of time, can have a shock effect, if you will, into inflation expectations at the long end of the curve. Mm-hmm. So do we make too much of this? I see a potentially bearish looking set of candlesticks here. I'm not too concerned because we do have that jobs report tomorrow. You and I have talked jobs for a quick minute here, though. Dylan, now that you're on with us, what are you thinking about the jobs report tomorrow? Do you care about it? Does the market care about it? Should we care about it?
I mean, I think this particular jobs report, it seems like, on the margins less than other jobs reports. But you can never, I said this earlier this week, you can never dismiss a jobs report. It is, for my money, the most significant piece of economic data that exists in the United States, full stop. And, I think what we have going for us right now is that people seem to have a pretty good comfort level with whatever the number is going to be relative to expectations. But you can never rule out the possibility that you're going to get a jobs number that's wild. I think the risk right now is that the jobs number is materially weaker than expected because of CEO uncertainty about budgets, because of all the tariff cockamamie in the first half of the year that may have contributed to a slowdown in hiring. I mean, this is totally conjecture. And so there may be a world where the jobs number comes in well below expectations, if only because of the lack of confidence in budgeting, because of the lack of confidence in the cost of operations, because of the lack of certainty of the tariff. Now, obviously, nothing that I just said is not within the totality of all the integrated analysis of expectations. So one would presume that whatever the forecast is here for the number, that forecast is accounted for that uncertainty. But at the same time, there's a reasonable chance it could be wrong.
The forecast actually is the number that we should pay attention to. Ilya, this is not a great number. It's basically the break-even rate for jobs growth in the U.S., expecting 100. And I just want to make sure, is that right?
I think it's 110.
Okay, yeah, it's 110,000.
That'd be the lowest in 8 months if we hit it on the figure.
Which is interesting because at 110,000 jobs, that does not keep the unemployment rate in check over the next 12 months. But then again, the expectation for tomorrow is to see the unemployment rate rise to 4.3%. I have to say that does not concern me in the slightest, because the last month's unemployment rate was 4.244%. And that didn't get rounded up, but if it was 4.245%, it would have been 4.25% and then 4.3% already. So a 1,000th increase in the decimal, okay, that's the line between 4.2 and 4.3 as of last month. So seeing a slight tick up here is not a shock. But when you get to 110K, we're starting to get into the zone where jobs growth may be at a place where it's not necessarily replacement level, where you're going to get a little bit more pressure on the labor market moving forward. If we think that the second half of the year has to be defined by good news, is this good news that we're getting jobs growth, but it happens to be much weaker than we need to sustain the unemployment rate at current levels?
Well, this is the key question, right? Because I'm going to say this until I'm blue in the face until this actually corrects, but there is a huge disparity between what the Fed is saying about the economy and what the markets are saying. And somebody is wrong. And what the markets are saying is that there's not an inflation concern because the break-even rates in the bond market are back to basically the April lows. And Fed funds futures are saying the Fed is going to do 120 basis points in cuts between now and the end of next year, which is about 50 basis points more than what the Fed is saying. So unless you think it's in the post-May 2026 period, because the markets think, Powell's term is going to end and the president's going to put some lackey in there to cut rates. No, that's not the way that the markets are pricing this out. It's fairly even spread over next year. So you look at this and you go, okay, what is it that the bond market sees? Why aren't they concerned about inflation? Why are they basically telling the Fed, you're not doing enough based on what you're saying, you're going to end up doing more? That speaks to some kind of an economic downturn that the market is envisioning. And although the economy has definitely taken a step lower versus where it was at this time last year and all through the second half of last year, it's not like coming apart or anything. And so Powell's argument actually sounds relatively reasonable. Look, I have a jobless rate, 4.2, 4.3%, and doesn't actually matter. By history's standard, it's not that high. In fact, it's not high at all. Inflation is at 2.4%. Looking at the latest CPI, that's not anything crazy. So why would it make sense to get concerned? Well, in looking at Powell's argument at face value, it's very reasonable. Why jump on rates now? Why do anything? The economy is fine. Why not wait and see? But the markets are very clearly saying, no, that's incorrect. So in that sense, you get a soft jobs number and the market sounds right. Is that a source of optimism? Or is that optimism already all in the market because the market is already tilting to pricing all of this out? Is this good confirmation? I suspect not.
I don't know if you guys noticed today, but the anti-fiat cohort of assets did pretty well. Silver prices here continue to hug the October and March highs, riding that 1 month moving average. They're starting to potentially perk up. But my interest is in what's happening with the cryptocurrencies here, because Bitcoin, very quietly, you only see it in the futures market, but we put in this bullish engulfing bar. We were below yesterday's low. We closed above yesterday's high, where we've been talking about having interest in IBIT because of the technical setup here. That's starting to look like a bit of a breakout right now. And I don't hear anyone talking about crypto. Dylan, the top story right now on Fox Business News and CNBC is about how the House GOP is fighting with itself to figure out what they can do with Trump's bill. And it seems like the fighting is about just how big the deficit's going to be, right? There's no more earnest attempt at actually producing a budget surplus. If who's going to solve this then, right? Like, it isn't, to take a step back, big picture on Bitcoin, the dollar's being diluted. The U.S. is on an unsustainable debt and deficit trajectory. Here you have Elon Musk and Doge and Donald Trump coming in saying, we're going to fix it, and this is the best thing that we can produce. Who's going to fix it then? Who's going to have a mandate to fix it if Donald Trump and Elon Musk didn't? Why shouldn't Bitcoin be trading higher?
So let me just make sure I'm tracking the logic. You're saying the last hope for non-abusively spendacious American government was the Trump-Musk operation. Is that the first assumption?
I think that is the understanding for a broad swath of the American public that's engaged politically.
So the last hope for sort of to get it under control was a Trump-Muskian sort of Doge-driven intervention.
Let's put this to the chat and I'll read it back. For those people that voted for Trump, right? Did you think that like fiscal restraint was part of the message, right? Was that part of the deal? Right. I mean, that was my perception.
But I think that's a reasonable to high level sort of assumption.
Okay.
And now you're saying, well, obviously that's off the table because you got maniac deficit. You'd think a Democrat was president looking at a budget like this in terms of the deficits and the recklessness and the madness and the absurdity and the preposterousness.
A former Democrat is president. Go on.
Therefore, you're saying that this then leaves the dollar and the sort of traditional currencies more vulnerable than ever to the fruit birdery that is the government. Fair?
Fair.
Thus, non-fiat assets, i.e. Bitcoin, should be more valuable.
Correct.
Mm-hmm. What about the fact that Bitcoin in and of itself is its own freestanding fruit bird, and that its very existence is its own uncorrelated exercise in pre-posterity, or preposterousness might be a more appropriate. I guess, to all jokes aside, I'm not sure that my jokes are particularly jokey. It's not clear to me that Bitcoin is any more credible than any other asset. All assets are up, and I think that the whole story is in the U.S. dollar. I think that whatever's going on here, that the real liabilities of everything that's happening is in the continued weakening of the most fundamental most fundamental financial asset on earth, which is the U.S. dollar. And so isn't that
the Bitcoin story then? Right? Like, forget Bitcoin.
It was.
It's the everything story.
How's it quoted though? BTC/USD.
But so that's the whole thing. That's everything.
Even if it's fruit batty, right?
Listen,
Dylan?
they don't call Bitcoin a fruit
battier.
bird for nothing.
It could be fruit birdier. That's what I'm saying. Like, Bitcoin could be a fruit bird, but the US dollar could be fruit birdier at the moment. And if you think of it like a currency, Ilya, everything's relative. It's just a matter of relativity.
There is certainly a lot to be said for the immense shellacking that the US dollar has faced as being a reason for all things not the US dollar to go up. But given sort of my general conclusion that Bitcoin's fruit birdery is entirely undesirable, I would rather own the euro or the pound or some other liquid, reasonable
dollar.
Yeah, some sort of other dollar alternative. And that's the way I've been expressing that view all year, is basically buying major currencies, all of them, at one point or another. I wonder now if the dollar isn't ready to make a turn because it's been getting absolutely whacked all year long with no respite. You'll notice that whereas both the dollar and bonds and stocks kind of had a uniform sell America terrible crescendo in early April, and bonds have obviously been slower to come back than stocks, but they've both come back. The dollar has not. So in my mind, you're starting to get to a place, maybe, where the dollar is again becoming a risk-on, risk-off type of asset. You're kind of seeing it in the divergence of the way in the way that the dollar is behaving against different currencies. For example, I am right now both long and short against different currencies. I'm long the Aussie, I'm short the pound. Both are working. And that gives you a sort of risk-on, risk-off dynamic within the dollar itself. So my sense is that if stocks give way here, the dollar is going to rally. Not because its yield profile is improving, but because everything we just saw in the second quarter was about this idea that maybe we're going to crash the dollar-based economic order, and then coming to the conclusion that actually, no, we're not. And so if that's the overall conclusion, I don't really want to be long any highly volatile, high beta, jumpy dollar alternatives. I'm happy with the Aussie dollar as a way to get a little bit of a risk on tilt somewhere, since I'm not going to do it in stocks, and see what happens. But my sense is that the dollar is getting ready for a rebound of some sort.
I don't care if this is fake news. Apparently, there's a report from Notice, which says that during a meeting, Trump told members that they want to win their re-election, they shouldn't touch Medicaid, Medicare, and Social Security. To which one Republican in House leadership says, "But we're touching Medicaid in this bill." I don't even know if this bill passes, but if it doesn't, right? Like some form of fashion something is going to pass, right? So, but Dylan, you say
a bill will pass.
Ethereum's up 8.15%. If this is fruitbertery, right? Don't we just have to learn to embrace it and love the bomb? Go Dr. Strangelove on this thing. If pigs are going to fly like Ethereum, it's up 8.21% today. Rather be amoral and rich than smart and poor, as you said yesterday?
Yeah, I mean, I said it yesterday. I mean, I do believe exactly that. You know, I think the only question is sort of where to get the best bang for your buck. Is it in Bitcoin? Is it in Ethereum? Is it in the NASDAQ? Is it in the Mag 7? Is it in the financials? You know, that's I think the most interesting discussion right now from a purely trading perspective is not up or down or whatever. It's of the things that are going to go up, what has the best risk reward, the highest probability to go up the most relative to the lowest probability to lose value. And I think that's where the most interesting conversation is at the moment. And I don't honestly know what the answer to that question is.
Highly levered coal companies that are going to get a ridiculous amount of tax cuts. Wouldn't that be something that's really crap that hasn't performed well? What am I thinking of here? Here's BTU, Peabody Energy, looking like it's carving out a bit of a bottom. This was just in November after the election, by the way, a $30 stock. It's currently trading at $14.68. Alliance Resource Partners, again, after the election, hits a high of $29.44, so it's not terribly depressed, but about 10% weaker. Arch Resources, this has a big rebound today as well, right after the election. Actually, what's going on here with this chart? Was this purchased out? This was bought out. Oh, I didn't realize it stopped trading. AMR, this is up 13.3% today. But Dylan, that's kind of the point here. Where are the big outperformance in the market as this bill's coming on? You talk about stuff being pumped up, if it's Bitcoin or whatever. Maybe the play is just these beaten down energy companies that have low valuations that now are going to have the spigot opened up for them. I mean, AMR here, look at this thing. This was trading back in the what? 240s around the election. It's now a $120 stock. It's taken a 50% haircut. Why not pump again? I think we should take a look at this, Ilya.
I mean,
we're going to do the crappy things. Let's do the crappy things.
In my mind, it's to want to go do crappy things makes sense.
Not wanting to do them, feeling compelled and have to do
feeling compelled to do crappy things, sure, is a sort of bet on the slow and steady melt up generally continuing, because it is a bet on overall risk appetite being something that broadly survives. Otherwise, people aren't going to be in these names. We're going to a correlation 1 sell-off, and that's it. So, for me, what makes this something that I'm not compelled to do isn't that it's not a good idea. It's the timeline. Because to me, the disparity between what stock markets are doing and what bond markets are showing suggests that there's some kind of a reckoning here that's going to become a defining theme for the second half of the year. We just spent the first half of the year basically on a single yo-yo bounce. We bounced down, we bounced up. We're where we started. It's January for all the S&P 500 cares. And so the question now, I think, is, okay, that was fun. What's going to be the theme for the second half of the year? And that disparity between stocks and bonds seems like the place where something needs to click, either this way or that. And then the markets will know sort of generally where they're going. Because a lot of what we're doing here is we're talking about things that are, for the most part, known. I don't think, by the way, that the markets went into this year expecting this administration to be restrictive. I think very clearly there were absolutely no pretensions to the fact that both candidates in this election are expansionists, that one of them wanted to raise the deficit by cutting taxes, and the other one wanted to raise the deficits by increasing spending. I don't think that was lost on anyone whatsoever.
Line goes up either way.
Right. So I don't think there's anything shocking in this legislation in the sense that it increases the deficit or that Doge was a farce or that, I mean, I think the markets knew all of these things. And so that we have this disparity between the biggest pockets of liquidity in U.S. markets seems to suggest that some kind of a reckoning needs to come. It doesn't have to be negative, but some sort of a thing needs to get resolved for markets to get on page and define what's going to be the second half of the year in general terms, to set the lens for it, much like the Fed sets the lens for policy once a year at Jackson Hole, incidentally coming up in August. So for me, I think that the disparity resolves in lower stocks and higher bonds and a dollar that bounces and then sells off again, and gold prices that go higher. But who knows? What I got
a second half of the year for you right here, Elliot.
Yeah. What I'm
It's
not
1998, 1999 again.
I mean, maybe. What I'm not prepared to do is to say that we can with certainty say that at this point right here, we know the way that it's going to resolve, and we know that the environment for overall risk-taking will be good. If the environment for overall risk-taking isn't good, picking names here and there isn't going to matter.
There's just a part of me, and I think, I was talking with Mike Butler earlier today about this, how it's just like the season of like everything kind of feels fake. It's just the season of chase. Those weren't his exact words, but he used stronger language, and I don't want to put him on the spot like this. So we'll just leave it there. That captured the spirit. People are underinvested still. Stock traders are still short. We know that asset allocation people have become very bullish, but those are long-term fund managers. I'm talking about traders, speculators who are trading futures for simply the sake of trading futures to make money. And that lot of folks have been holding short this entire way. We're going to get out on the other side of July 4th here, Dylan. Actually on this chart, this was produced on June 24th, so that puts us basically here on our chart. So let's say we get a few more days of chop. We could follow this thing into the August, September. We don't have a big pullback, but if we're going to go nuts, why not just lean all the way in? Why not just embrace the crazy? It's going to be like the dot-com bubble. We're going to do tax cuts. We're going to do SALT deductions for the wealthy so that they can take more of their hard-earned money to put it back into the stock market. We're going to get cheap energy because we're going to burn all the coal.
No, I get it, but so you're saying the just buy the S&P and don't keep it simple, stupid. Is that what you're going with here?
I'm compelled to say that because I'm reminded of some of the research we've shown in the past about kind of what trading style is most efficacious depending upon the volatility regime you find yourself in. And just for the sake of that study, it was when you're at 15 or below in the stock market, the best thing to do, both in terms of average daily returns and standard deviation of daily returns, would be to just simply get long stocks in some form or function, buying the index, buying an at-the-money call spread. And right now, the front month expiration has dipped into 14.97. We're below 15. We're back in that territory where you just kind of got to be a numbskull knuckle dragger like I was for so long last year, like you were, we were all for some time last year, was just like, hey, this thing's floating up. I'm just gonna buy the market and not think too hard about it. I know it feels dumb and there's so much noise out there, but Dylan, I think you made a really good point the other day. If you overthink and you react too much to the news, you're gonna drown. And you got to just kind of look at what's on front of you in the screen. And not that nothing matters, but there's incentive.
But
right
just
now
go with the math. If there's more money available, and especially more money available to the wealthy, it goes into stocks and real estate. Full stop.
Goes into stocks and real estate. Full stop.
Maybe some art. I don't know. It's pretty. Maybe a few diamonds.
Art. Diamonds are such bad business these days because they can make them
jewels. Some jewels for the lucky lady.
Maybe a new car. I was able to just negotiate a really good deal on a new car. Got them got them to drop down $100 a month by playing 3 different dealers off of each other. Yeah, I feel pretty good about that.
Congratulations. I guess the only thing is the sort of counter argument to this whole thing, for at least from my perspective, is too late, pal. Like, there's a stock market's already at records. No surprise here. Everybody thought the bill was going to pass. They priced it in a while ago. If anything, by the time this thing clears the finish line, it's sell the news, because the back end of the sugar high is a social and currency catastrophe.
I was under the other impression, or different mind, that the non-farm payrolls report would actually be important tomorrow, because if we started to tilt into this territory where private sector payroll growth, and even if it's ADP and we dunk on it, if it's going to be bounding around in negative territory, it shifts the focus on, can the Fed cut because inflation's sticky, to it's a different type of Fed mistake, right? A Fed misjudging inflation for not being as warm is not as bad as a Fed not understanding that the labor market is weak. So tomorrow's jobs report, right, if we then go back to some of the numbers we ran yesterday, there's 8 occurrences in history in which the market was down by 8% or more at one point year to date, only to finish the first half in the green. The only 2 times where the second half of the year didn't produce gains, 1958 and 1990, years that had recessions coming into the back half of the year. But all the other times, when you have that V-shaped rebound in the first half and there's no recession, the market stays up. So tomorrow's jobs report, right, if it is a soft number, if it's a negative number, I think that scares the hell out of the stock market, because all of a sudden that 23% chance of a Fed rate cut, that's going to get pulled forward. And it's like the Fed may have to cut rates for recession reasons, because can they afford to go all of July, all of August, into September without providing support? Because if they don't, you're basically going, from now until the next September cut is basically a quarter of the 20% of the year. So you're going to run off the clock 20% of the year if you don't cut in July. And that's why we also have to entertain the September 50 basis point cut, because they could really feel like they're late if things percolate. That's one of the reasons why I'm not worried about bonds either.
Yeah, this is an important part of this. It isn't just that since the June meeting, the markets have been baking out more rate cuts for next year. The probabilities for this year, for July, for September, for October, have become more dovish. The market is very pointedly looking at the Fed and going, that thing you said? No.
No. Well, that's why I'm not so worried about bonds tomorrow, because we know the long-term research shows that bonds go best places to hide during a recession. So if it's an exceedingly weak jobs report tomorrow for whatever reason, the metals should be on, decent enough ground. Copper probably not so much, but the metal should be on decent enough ground. And then I would think that bonds are going to be on decent enough ground there moving forward. Yeah. Dylan, I I saw a headline today because this is technically the last overtime episode of the week. A quick programming note. Tomorrow there's no afternoon Tasty Live programming, so we'll get through non-farm payrolls. You'll have Tom and Tony. You'll run into noon Eastern, and then that's it. There's no Futures Power Hour, no overtime. Dylan, this report makes me feel like either I'm a total idiot or, I don't know, maybe there's a great opportunity around the corner. AI virtual personality YouTubers or VTubers are earning millions. Apparently, there's a few of these folks with millions of subscribers. Folks, what are we doing wrong here that we don't have millions of subscribers, but some AI, CGI folks do?
Novelty, baby.
Dylan, is this one of the flags? Microsoft laying off 9,000 people with no intent to replace them because AI can do all the work. Content creators quickly becoming AI. When should the three of us start to worry?
I don't know that. So here's my thought. Pretty soon, the most valuable thing of the world is going to be live in-person interaction of all kind. Because as AI takes over, I believe the desirability and interest that anybody's going to have in non-in-person content is going to collapse, because people are not going to be able to tell the difference between us talking as we are now in a non-AI form and an AI version of us or of anyone. And so I think it's less about the future of content in the digital form, although I think that's relevant. I'm less concerned about our future or the future of those who sort of do content or entertainment for a living. I think that it's a massive opportunity for all live events. So maybe our future is where we are gathering people together in person, as Tasty already does. But I think that the number one shift here in terms of increase in value for live humans is going to be any person-to-person interaction. And that to me is more certain than the uncertainty of whatever the variable is of, sort of the decay in trust in non-in-person content, because of the fact that basically all news pretty soon will be fake news.
That's so interesting that you put it that way. I've had that same thought independently when talking with people. What's the best way to build off trust with individuals? And it's not by checking the boxes and sharing the same values like online. Although, and I think actually the internet has created these insular communities before everyone has their kooky view, but it's only you, and you say it to your neighbors or the people on the street, and chances are you don't find anyone else that shares that very niche interest or perspective. Now, you could find thousands, millions of people who share that same niche view. But that handshake, talking to people in person, looking them in the face, right? I know this person's real. They're not just a construct on camera, which I suppose is a good pitch for the tastylive.com/events page. We're in person quite frequently. Ilya, yes. Before you go into macro money here, give us a brief preview of what you're discussing today.
Not surprisingly, I'm going to be doing a deep dive on the jobs report and sort of how the tea leaves are laid out before the numbers come out, and really why this matters, and sort of showing the disparity in markets and what that might mean, sort of where we might be off sides if there is regime change macro-wise for the second half of the year. Because it does look like the first half of the year had the theme of, wait, this is not the Trump presidency we signed up for. Oh my God, no, wait, it's still okay. And the theme for the next half of the year may well be, right, the dust has settled, where's the economy? And if that's the shift, this jobs data may very well be a crucial first step.
You can catch Ilya immediately after overtime. He's on Macro Money, Monday through Thursdays here on Tasty Live, 5 p.m. Eastern. I'll be back later on as well with Victor Jones for The Price of Truth, 6 p.m. Eastern, so be sure to tune in and stick around for Tasty at Night. But with that, for Ilya Spivak and Dylan Radigan, I've been Chris Vecchio. We'll catch you all next week on Overtime next Monday. Good luck trading until then. Stick around for the break because Ilya's back with Macro Money shortly.
See you there, everybody. Well, it's that time of the month. We are looking down the barrel of the monthly U.S. jobs report, and there is plenty to talk about. Markets are relatively quiet here as we get into the week, and we have a generally content start, it would seem, to the second half of the year, but a defining theme is yet to emerge, and maybe this jobs data will be the catalyst. This is Ilya Spivak, head of global macro here at tastylive. This is Macro Money. And what we'll do here first and foremost is take a look at how we are setting up across the major markets for this data, how we came in today as we got the first days of the second half of the year and of the third quarter under our belts, and then see what this data might start to do to shape what comes next. Because as we've been talking about for the past several days, there is a glaring disparity that now emerges in stock and bond markets, and one way or another, it's going to resolve itself. And this data may be the beginning of how that happens. So just looking at the performance here for the day so far, Bitcoin had a nice jump, 3.9%. Crude oil, the standout, though, as far as moves outside of the realm of the usual. Crude oil having a spirited rally here after a few days of consolidation following those wild swings around the Israel-Iran conflict. And the data today on inventories, interestingly, seems to be the driver that inspired what we're looking here. The interesting thing here is that actually overall inventories for crude oil went up, but after a long period of sharp declines. So although the overall inventory number was up by 3.8 million barrels, that's after 5 months of blistering drawdown, most impressively an 11.5 million barrel drawdown in the middle of June. So with this sort of an aggressive 5-week run, it's not surprising to see a little bit of a build, but the standout was a jump in crude oil imports that seemed to speak to significant demand, an increase of almost 3 million barrels. That would be the largest rise since August of 2023. So perhaps a sign of improving energy demand here, and crude oil sharply higher on that. Otherwise, another slow push into the highs for the S&P 500. It continues to hover near the highs of the year and figuring out whether it has the temerity to break them. NASDAQ rebounding from yesterday's losses, now basically unchanged for the week. A little bit higher, but only very, very marginally so. Yields a little bit higher, the 10-year, the 2-year up across the board, and that might be linked with this jump in crude oil. That's the kind of thing that tends to echo into inflation expectations and nudge up yields, and indeed that's what we're seeing here today. Gold a little bit higher, the dollar a little bit lower against its major counterparts. Gold has been attempting to stage a recovery for the past several days, as a matter of fact, and its attempts have been, for the most part, fruitful. We're looking at gold prices now that for the past 2 days have erased almost a week of downside progression last week, and at this point are maybe about 50% of the way back in the direction toward June's highs. So a spirited rebound there, perhaps in the spirit of a slightly weaker dollar and unbothered here by the pop in yields. But of course, all of this is sort of tinkering at the margins when we consider that the week's real big macro catalyst still beckons. And that, of course, is the June jobs report. The expectation here is that we're going to get an increase of 110,000 to overall non-farm payrolls. That's a rise that would amount to the weakest in 8 months. The jobless rate seen going up to 4.3% after holding at 4.2 for quite a while. That's certainly an increase relative to history. If we consider how that stacks up over time, it's the highest since October 2021, if it happens as expected. But nevertheless, it is still quite low by historical standards. Now, an interesting bit in this story, as we sort of look at what these numbers might mean and what they might do, is what automatic data processing told us earlier today, ADP. They put out a private sector estimate of job creation. And before we sort of delve into this, it's very important to note this is not usually a good month of foreshadowing or prediction of what the official NFP numbers are going to be. So in seeing these numbers for June, we wouldn't necessarily jump and say, well, NFP is going to be that. But it does create a sense of general conditions in labor markets that set up what the risk of surprise might start to be in incoming jobs data. And what we find here, of course, is that really since the middle of last year, there has been a steady slowdown in private sector job creation. But really what made June stand out was this negative reading. So ADP told us that in June, private sector payrolls declined by 33,000. And this was actually the worst result and the first time that we've seen a negative reading, as we can witness on the chart here, since March of 2023. So not exactly a happy sign here for labor markets, and adding to a general pile of evidence suggesting that the labor market is weakening. Last week's jobless claims numbers, this is a 4-week average of initial claims, so first claims for unemployment benefits. We can see here, we're looking at some of the highest levels here on this 4-week average in 2 years. We'd have to go back to sort of the middle of 2023 to get something comparable. When we look at continuing claims, it's not much of a happier story. This is sort of the next iteration of claims, and as this rises, you get the sense that people are having a hard time finding a job once they lose one, and so they're extending benefits. Continuing claims now at the highest level since November 2021. Now, a slight bright spot in this equation has been a piece of data this week on job cuts, but it's only a bit encouraging, if encouraging at all. So we did get what was the smallest number for reported job cuts at around 48,000 so far this year. And this comes to us from Challenger, Gray and Christmas, which is a consultancy. But that's after a very dramatic spike earlier in the year. You can see here, this jump in layoffs was, in fact, the largest such thing since back at the onset of COVID. And we're looking for the year as a whole at 744,308 job cuts, which is the most, indeed, since 2020. So it is interesting, of course, to see moderation here, but what this is a return to trend rather than anything particularly encouraging. And then, of course, as we talked about yesterday, the ISM manufacturing survey gave us the fastest pace of contraction on the employment side in 3 months. As ever, this is in the logic of PMIs. So above 50 is growth, 50 is neutral, below 50 is contraction. The further you go below 50, the faster the contraction. The further you go above 50, the faster the growth. And so what we ended up seeing was a fourth consecutive month of contraction in the manufacturing sector against a backdrop of surging prices, falling new orders, and falling employment. So giving us that sense of a stagflation type of data set. Now, obviously, we're not seeing stagflation realized in the overall economy, but these kinds of numbers, if only just looking at the employment component, certainly suggest that the labor market appears to be under duress. And this kind of slow and gradual descent in the amplitude of job gains may finally be reaching some kind of a point of acceleration. Now, we do have, in addition to this jobs data, the service sector part of the ISM report. It is expected to give us basically steady growth, 50.5, so just a touch above total standstill. And when we compare that with what we've just seen, this overall 49 on the manufacturing, we probably have something that levels out to a composite of maybe 50 or just a hair above if we get the numbers as expected. So we'd be looking for an economy that's essentially at standstill, barring some sort of upside surprise. And on the jobs front, we can see that in the prior month, jobs slightly, by a narrow margin, returned to growth in services. We'll see if that momentum holds up, but the general trend since the post-COVID catch-up peak has been toward slower and slower job creation, and increasingly more and more time being spent sub 50, that is to say, both sectors losing jobs. Now, as we've seen over the past weeks, really going into the beginning of June, U.S. economic data has pointedly diverged in a negative direction from the global pack. This is Citigroup data on economic surprises. And we can see here that increasingly U.S. economic data is faltering relative to forecasts. Here's the zero line, which would amount to the data basically coming in line with expectations. And when we look at what's been happening essentially since late May, is this persistent weakening in data outcomes relative to those expectations, implying that basically analysts' models are off, and they're off in a rosy direction, notwithstanding some one-off jumps like the durable goods orders report last week. Moreover, we can see that the weakness in the overall global index is mainly rooted in the US, because we can see here that it is the G10 set that's pulling the global average lower as emerging markets hold up. And within that G10 set, it's the US that's pulling things lower and Europe that's holding up well. So while the US economy may be in absolute terms in a much better growth sort of environment than is happening for the other major economies, Europe is effectively at standstill, and so is China, as we just saw from PMI data over the weekend. So we're looking at a situation where the U.S. is certainly the brightest of a dim bunch as far as economic growth is concerned here amongst the major economies, but the direction of travel is pointedly more negative. And so it seems like what's occurring is the U.S. is converging on weakness elsewhere, rather than weakness elsewhere converging on strength in the U.S. We see a similar story in this Atlanta Fed GDP Now model, where, never mind the level, the story here seems to be that, again, since about late May, the tone of the data going into this model to inform where it's going has been decidedly negative, which is why the model is getting revised lower as this data comes in contact with the overall basket here. So never mind the fact that there is a vast disparity of expectations for what fourth quarter growth may actually, or second quarter growth rather, may actually look like. The range is unusually wide, from 0 to almost 4%. We're still far enough away from this data that these things don't actually matter all that much and will even out. But more importantly, the data informing the model is telling us the general trajectory for data flow in the US is toward weakness. And this speaks to the disparity we've been eyeing in bond markets. This is what we mentioned at the top, is this disconnect between what's going on in stocks and what the bonds are saying. So if we back up here to mid-February, we can see that stock markets start to sell off around when business and consumer confidence surveys start to say that the rollout of the tariff regime from the White House is spooking people and hurting demand and weighing on economic growth dynamics. We see at the same time that the inflation expectations baked into the bond market are falling with stocks, as if to say, okay, we have an economic slowdown, earnings outlook is worse, growth outlook is worse, so inflation outlook is lower. This is a deceleration in growth writ large.